on a Sunday morning after I've written the supplement to be able to do one of these live discussions. But today is one of those days. So, what are we talking about today? Well, 119 years is going to be a number you're going to remember at the end of this video. Why? Because that's how long, at the current rate of building, it would take to clear England's social housing waiting list. None of us, unfortunately, watching live today, will be able to see the end of the housing emergency at this pace. Welcome to the supplement. It's been a heavier week than most, ultimately, with a possible ceasefire, which might not survive contact with Tuesday, let's face it, but we're closer than we've ever been to the end of this war, apparently, according to Mr. Trump and a few of the other players in it. We've got a rates outlook that now is completely and utterly flipped, which we've got to talk about in some level of detail. And we've got a whole flurry of reports that are realistically all pointing to the same affordability wall. This week's quote: the great cause of inequality in the distribution of wealth is inequality in the ownership of land. The ownership of land is the great fundamental fact which ultimately determines the social, the political, and consequently the intellectual and moral condition of a people. And that was from Henry George back in Progress and Poverty in 1879. What does that fit with this week's efforts? Well, a select committee, a charity, and a think tank have all circled the affordability of housing, without quite saying the quiet part that George said out loud back in 1879. Under all the schemes and subsidies and savings products, it comes back to land. We tax labour, we subsidise demand, we tinker with deposits. And the one thing that is actually scarce, that actual ground to build on, goes quietly unaddressed. 140 odd years on, with the home ownership back below where it was 2 decades ago, and a bank of mum and dad doing the work the market won't, the old boy reads as bang up to date. So, here we go. What are we going to do over the next 90 minutes and what's going to weave together? So, Trumpwatch, a section I can never leave out of the supplement these days. 2 genuine main characters this week, and some of you will probably be pleased to hear, like I am, because we've all got a bit of Donald lag, haven't we? Let's face it, folks. Neither of them is the president. The man he's installed at the Fed certainly is, and also we've got to talk about the war. Has it lurched after 3 grinding months towards a ceasefire? Well, there's a maybe in there, I'm afraid, and that's doing some heavy lifting, folks, I'm afraid. As always, we'll talk about the real-time UK property market. Softening, definitely. Selectively softening, very important. Collapsing? No, there's not going to be any sensationalism here, folks, I'm afraid. But we have now got 3 independent data sets which really agree on the shape of the market. So I'm going to lay those out for you. And then the gilts, of course, we always talk about the gilts because we've got to talk about the rates conversation and the 180 that that conversation has done in 6 months or since the war. How many cuts are we having this year? That was the argument. I said 1. I was wrong. I was wrong on the side I didn't want to be wrong on, though, because there aren't going to be any cuts this year, realistically. The next move is a hike, folks. But I'm going to try and do what I've done in the past and try and predict the correct score in terms of the vote. For those who don't know, who aren't as much of a nerd as I am, there are 9 people on the Bank of England's Monetary Policy Committee, including the governor, and then luckily 8 other people who are actually quite good at economics. I'm going to try and tell you why they're going to vote in this week's meeting and predict their exact scores and what they're thinking at the moment. Not easy, but let's have a pop. And then, of course, we've got the deep dive after we've had the whole macro section as well. 4 reports on why nobody can afford to buy, apparently anyway, and why building more will simply nowhere near fix it as fast as any of the slogans have promised in any of the political parties. So I've been talking for months now about how this rate story is turning, realistically, from the 28th of Feb, when the whole Iran situation started. On the 17th of May, I was talking about whether the cutting cycle was going to bottom at 3.5 or 3.25, and that being a long way in the past. That was the chat from February in the real world, right? In May, we knew it was long gone. In April, we knew it was long gone. Now, as we stand today, the curve is ultimately pricing in a higher base rate in a year than it is today. Same direction every week. Finally, it's arrived in spite of the end of the war, realistically. And thanks for tuning in today, folks. I just want to take a moment to tell you about our upcoming property business workshop. It's in central London on Wednesday, the 1st of July. The core subject in the workshop is due diligence. I'll be presenting it with my friend and business partner, Rod Turner. We're not just talking about the boring bits of due diligence that you know you've got to do on, for example, potential JV partners, or ultimately the sort of due diligence that people are carrying out on you, because that's extremely important in today's world. You will miss 100% of the shots that you didn't take, as Michael Jordan would say. But we also get to talk about due diligence on deals, due diligence on potential lenders. And that's right, yes, people who are going to lend money to you. What DD do you need to do on them? And what sort of DD will they do on you as a borrower? These are all key to the property businesses that I know, and certainly to my own property business. But we'll get into some juice of due diligence of deals, the stuff that Rod and I use ourselves. And we always have a wonderful VIP dinner section as well afterwards, so you can get some one-to-one time with myself and Rod, and everybody at that dinner gets a slot to talk about currently what's going on in their property businesses and anything that's holding them back. So it's the best way to get a bit of accessible time to us. So there's a link in the show notes on YouTube. You can try tinyurl.com/PBWELEVEN as well, or just Google Property Business Workshop 11 and you will find the link. Hope to see some of you there. Okay, let's get into Trumpwatch. It's where we usually kick things off these days. It's the war and it's the ceasefire that isn't, realistically, right? We've got to lead with what's gone on. I've said this a number of times on the lives and in the supplement over the past few months. This could well end because Donald Trump sort of wakes up one day and is a bit bored of it and wants to move on. And it honestly looks like that's something like what's happened. We didn't believe too much what we read in one of his 8,304 rambling tweets, or truths, as they're so deeply ironically called, of course, in the middle of the night, or in the middle of his night, sort of Thursday, Friday, over the past week. But then we did get some validation from the Pakistani president, apart from anything else, who is injected deeply into this process. And I think that's when the market probably started to take it a bit more seriously, with the immediate effect, of course, of a dramatic raise in the bond prices in the UK and a drop, therefore, in the yields, rates coming down. That's good news for us, but we'll talk about that when we get into the full section. Ultimately, the oil price moved as well, dropped quite significantly. West Texas Intermediate under $85 a barrel as I talk right now. Brent crude under $90 a barrel. Really welcome news for people. But is that price getting ahead of itself? Well, let's see, because what we did see, apart from anything else in the gilt market, is we saw things, the bonds rise in price dramatically, the yields drop, really quite volatile for a bond trading day. 15 to 20 basis points very, very quickly changed. And then somebody said, hang on a second, he says it's over. Is it over? And also, the bigger piece behind all of this is, what about the lasting damage that's already been done by the war? I've been saying for weeks and weeks and weeks that ultimately it wouldn't be over when it's over. You're still going to have impacts of this, even well past ships are flowing normally, if there is going to be a normal or new normal, perhaps through the Strait of Hormuz, because ultimately people have run out of storage, people have run out of, pipelines have been stopped, stockpiles are an issue. There's lots and lots of things to consider before anything goes back to normal, and it will take between 3 and 12 months, depending, perhaps longer than 12 months, for some of those commodities to return to normal. And we'll be having fallout, just like we did after COVID, when we had a big supply chain disruption, for a long time to come yet. But that's sort of where we are, right? So the guns have gone quiet, but is anybody sensible really calling it peace? Yes, Israel has halted attacks on Iran, but Netanyahu seems to be refusing to use the word ceasefire, which just tells you how much trust there is in the room. Approximately zero, let's face it. Oh, and morning to the folks on YouTube who've tuned in, and a couple of comments. Nice to see you all. Welcome. Thanks for tuning in. Okay, Iran has also suspended its own operations, but it has warned as well that it will restart if Israeli strikes continue in southern Lebanon. This has been a big part of their deal breaker side of the deal. And this leaks out sideways through Hezbollah Iran fund Hezbollah, sure. Are they in full control of Hezbollah? I don't think so. Is Hezbollah's agenda at any point involve peace with Israel? Not sure. Does Netanyahu's agenda involve peace with Hezbollah? Seems unlikely, doesn't it, from what's gone on over the past few years. So we've got a new draft agreement. I think we had 20 or 19 points before. We're down to 14 points, so we've obviously struck a few off. Lifting of oil sanctions, right, on the Iranians, but also an Iranian commitment to reopen the Strait of Hormuz within 30 days. Now, Trump said this weekend. Not sure we'll get there, of course. I'm not sure we'll get there in 30 days. He is a man who's known for his extensions. Perhaps I'll just leave that there rather than talk too much about Mr. Trump's extensions. We've heard this so many times before. They call it the taco trade for a reason. Trump always chickens out. Will this really get done? The April ceasefire was going to last 2 weeks. Look, it's encouraging. Is it better than everything? Can you understand why the markets have reacted the way they have? Absolutely. But the markets hadn't moved hugely in the first place, really, given that we had a whole number of supposed energy experts telling us this was the biggest single oil shock we'd ever had. And those of us who know our economic history, or perhaps are old enough to remember back to the 1970s, were really, really worried when we heard people talking like that. So let's just see what happens. So is the oil price getting it wrong? Has it moved too quickly downwards? Brent crude was down 4% on Friday. It was actually below $86 a barrel at one point. That was lowest since early March on the chatter of the deal. What's the problem? Well, there's a great phrase that the traders use in these situations: buy the rumour, sell the fact. And that ultimately is what's being done here. The rumour is what's being traded. Markets work on a very emotional basis. And that's what we're seeing, right? What have we seen with Brent crude, given that we saw that price under $86, right? Shooting stopping is not the same as the supply coming back. That's the cornerstone of the argument here, right? And we seem to have conflated the two, or the market seems to have conflated the two in the rush to the top. So what's the context? I always moan about people not putting enough context into what they talk about. How good or bad is $86? Well, Brent went past $140 a barrel very, very briefly in March, which was our highest number since 2008, when Hormuz was shut and when 20% of the world's oil supply was stuck behind it. That was very, very temporary. You know, we didn't spend a lot of time above 120, and we didn't spend a huge amount of time over 110 a barrel, but that was the spike, right? So how does oil actually normalise from here? Well, even in the very, very best scenario where Hormuz is opening up as I speak today, and all's very good, right? The strait's got to be cleared of mines, unless there's an admission that all these mines were fake in the first place and it was just gamesmanship. Fields that have not been producing oil for months have got to be restarted. It's not like you go in and turn a light switch on with these things, folks. There's been damage to various energy facilities as well. That will need to be repaired. And ultimately, what about war risk insurance coming back? Who's going to be underwriting those policies and at what price, folks? Underwriters don't tend to be particularly gung-ho. They're not famous for their aggressive risk-on sort of attitude to things. They're much more likely to price in a really quite punishing insurance premium for anything that's going to be falling through the straits, right? So this has fallen on this expectation of a return to normal, but the return to normal is months of physical work away, even if the politics cooperates perfectly, which, let's face it, it rarely does. So if Hormuz traffic does not resume within the next sort of 7 days, then some of this clip that's come off the prices is going to come back. This is going to decay back upwards as we see, once again, Mr. Trump might have been a bit too optimistic. But let's say it's not like he's failed on everything that he's done. He just tends to oversell and overstate things. It's kind of just what he does. It's his SP. Now, why does this all matter if you're looking at renting out your flat in Birmingham or something like that, right? Well, this damage already being in the system does not heal itself. So this oil shock has fed through into UK inflation expectations, and I'm going to show you all about that, talk about that in the bank's attitude survey later, the Bank of England's attitude survey. Very, very important. Inflation is all about expectations. Once they've drifted, and they've drifted, believe you me, you'll see how much, they get sticky, right? So there we go. But even a really genuine, durable ceasefire signed this weekend would not unspike the inflation that's already imported. This is one of those things people keep forgetting, right? Inflation, when the rate of inflation goes down, that is not prices going down. For prices to go down, you need deflation. Now, occasionally you do get deflation, prices actually going down. Oil is a great example, right? At some point in the future, oil it's already deflated a little bit from its highs, but it's still higher than it was a year ago. We tend to measure inflation in 12-month cycles, although we also do month to month, quarterly, etc., etc. Of course we do. But inflation coming down is not the same as prices coming down. And that's the mistake that people make. But once inflation expectations are up, they stay up because people negotiate their salaries once a year, if they're lucky, right? Rather than just getting told what they're going to get. And so their expectations for inflation are a massive driver for how they negotiate their salaries going forward. We do have to bear that in mind, right? It's also just not going to let the Bank of England go, oh, okay, it's all okay now, so therefore we can cut rates again. We can go back to this expectation of 1, 2, some people are even saying 3 rate cuts this year. Obviously, that's long gone, and we can thank Mr. Trump and Mr. Netanyahu for that. I use the word thank ironically there, of course, just to be clear, right? The rate consequences are going to be there for months, perhaps even a year. Think about it like a 3-day hangover when you've really been out on the smash, folks. That's where we are in context, in geological time context for this one, right? These precise terms for this deal, I should mention out loud, come from various channels that you're not going to bet the house on here. We go through a strange process, certainly some people do, where we can't trust the BBC anymore. So what we'll do is we'll trust everything that it says on Al Jazeera, for example. I'm not saying Al Jazeera is a propaganda outfit or anything like that. It's not how the sensible person does it, is it? You have to take in a number of sources. You have to give it some thought, some consideration. Let's see. What's Mr. Trump put pressure on people to say? Who knows? But one thing we do know is he loves to put pressure on people apart from anything else. But we're confident on the broad shape of this thing. There's a deal drafted. We believe that's not the first deal that's been drafted. Oil's come down on hope value rather than anything really concrete here. And the physical damage is real and lingering, right? Fine detail is definitely going to be provisional. And let's face it, this situation has reversed on a single Truth Social post before as well. So I walked through the blockade about 3 or 4 weeks ago in the supplement. That's not literally in text, of course. And for weeks, the war has been this single driver of the gilt markets, arguably for months, realistically. Although we have a bit of political wobbling as well in the UK, as you'll know, and that's made a bit of a difference as well. But ultimately, oil price has ultimately set these inflation expectations, not because we all buy so much oil, although many people still have petrol and diesel cars, of course, but it takes oil and the derivatives of oil to move food onto the shelves, to grow food in the first place because of fertiliser, not because of oil, bear in mind. But that's also obviously been massively affected by what's been going on in Hormuz. Little did we all know, but I don't suppose it's a fact we'll forget for some time. Now, what else have we got to talk about in the Trumpwatch section this week? I've also chosen, in my wisdom, to review the tariff situation because, remember, it's his favourite word. My favourite word is tariffs, right? I'm not so sure it is anymore, realistically, because what I wanted to do is try and do an objective analysis of how successful or not the entire tariff regime has been, because I saw some pretty chunky numbers where there were times where they were bringing in $50 billion a month and things like that. Now it's the US, so crazy as it sounds, 50 billion is not that much money, ridiculously enough. But are they going to keep it, was the question I asked myself. Because apart from anything else, so many of these tariff things keep getting knocked out and keep getting struck down by Supreme Courts and this and that and the other. And this is America, baby. So what happens ultimately is people litigate, people sue, people get their money back. And that, sure enough, is what they're doing. So a little bit on that piece, right? $23 million a day in interest payments going the wrong way for the US government while the courts sort out all of these repeal tariffs. And of course, we know what the tactic has been. Tariffs, Trump's got people in place whose instruction is to get tariffs on. Whether they hold up in court, That hasn't been a big consideration and a big concern. But we could easily see the American economy actually lose money from this tariff situation overall, or certainly not bring anything of meaning in anyway. So, we're 34.8% of the way through Donald Trump's presidency. And yes, I am watching it to the decimal place because I'm tired, apart from anything else, of Mr. Trump. Don't worry, I won't be giving up on the Trumpwatch section anytime soon. And I'm sure any underwriter would fancy Propenomix Adam Lawrence to last a little bit longer than Mr. Trump, especially if you see some of the close ups of things like his hands and all that fake tan he must use, and goodness knows what else that isn't good for him. The Big Macs and the Diet Cokes, but I mean, other drinks are available, so bear that in mind. But look, he's got form on this front, hasn't he? He's got a lot of form on this front. But there are the levers to think about. What has he really, and I think this is also something that gets lost with Donald Trump all the time when you try and have a sensible conversation about him, right? What's he really been trying to achieve? He's been trying to get people to come and put their factories in the United States of America. That would include Chinese car plants, right? And this is hardly, groundbreaking stuff. Nissan have got a big factory in Sunderland. Is that terrible because Nissan's a Japanese company? No, it's not. It actually has contributed massively to the economy of Sunderland. And again, it doesn't just mean people who've got jobs at the plant. It means from all of that, all the way down to the cleaning contract companies, the original equipment manufacturers who also want to be in the UK to supply to Nissan, and the people who cook the bacon banjos in the morning in the vans that serve the hungry Sunderland workers if they need to nick something after a night shift or before they start a day shift, right? Massive, massive part of the local economy. Nothing wrong with doing that. And you would say, if Mr. Trump was here, I'm sure he'd say, as long as they're employing American people and paying tax to the American system. That little bit's quite interesting, isn't it? That paying tax, because he doesn't mind if the tech bros aren't paying tax in the companies that they supply services in, or Starbucks for that matter, because you need to lump them in with the tech bros for not paying tax or not paying corporation tax, certainly in the jurisdictions in which they operate, like the United Kingdom. And look, you could blame the system, but I think this is exactly why you need the digital services tax that charges them 2% of their turnover over and above a certain amount. And actually, realistically, 2% is a joke. But then anybody who knows anything about tax knows it gets introduced and then it goes up. That is the straightforward taxation playbook of every single government ever, unless you get to a full breaking point situation. You could cite Sweden at certain points in time. You could certainly cite the UK in the 1970s and what Maggie Thatcher came in and did on that front. But ultimately, you had top rates of things like top rates of CGT at 98% and things like that, because it was old Dennis Healy. Squeeze them till the pips squeak. Sounds great, doesn't it? But really, if you've got capital gains up there, guess what happens, Dennis? No one sells anything, do they? So your revenue is zero. And it's not that clever, realistically, is it? Now, we're not in such an extreme situation in the UK. We have got the largest tax burden since World War II. But again, that conversation gets very, very confused, because what it doesn't do is highlight, for example, income tax. If you earn under 50k, you're in the easiest regime you've been in for about 30 years or more, right? And nobody realises that, but you pay 28% over and above your personal allowance. Okay, so you got your first bit for free. And so really that's quite good and redistributive for people who are lower down in the income brackets. And as I've said a number of times, likes of Gary Stevenson, who insist on talking about wealth inequality because it drives that resentment and the old comparison being the thief of joy, and let it take all my joy, take all the rich people's money, even though it would last about 15 minutes in terms of what it would fund, based on the people who would be stupid enough to stay in the UK if they were getting all their money taken from them for redistribution into the welfare system, realistically. That they would disagree with on many levels, of course. But I've said this a number of times about Gary, the technical argument. The wealth inequality piece is for clicks. It's rage bait stuff that he does. Ultimately, income inequality is a much larger problem. And there are lots of preeminent, proper, actual economists who get about 12 views on their YouTube like I do, who will tell you that this is much more about income inequality than it is about wealth inequality. But I digress, as I often do, right? What did Mr. Trump want to try and do with these tariffs? Bluff, force, bully? He doesn't care. He's not worried about it. He worries about results. He doesn't care how he gets results. You could say he does the same in terms of how he treats the fairer sex, apart from anything else, but perhaps we should leave that one alone. Ultimately, he's got form for doing this. This is how he does business deals, puts the big pressure on, and loves being the big man with the big stick to beat people with. And ultimately, I guess that's what he is when he's the US pres, right? The leader of the free world and all the rest of it. So you put your factories in my country. Now, what are the problems with that? Well, it takes a while for corporates to make big decisions like relocation. Yeah, not easy to open factories in the US necessarily, although it's very complicated. There are definitely areas of the US where they'll subsidise or at least do tax deals and things like that on people bringing factories to the US. But many people might have just taken a view saying, well, we know it's his second term. We know he's leaving office at the end of that second. We do know that, don't we? Do we know that? Do we know he's leaving? No, we don't know he's leaving, do we? Because we remember what happened on January the 6th, 2021, apart from anything else, and that might be nothing compared to what happens on January the 6th or whenever the date will be in 2029. But let's not worry about that too much for the moment. Many corporates would have thought, well, we'll just weather the storm for 4 years. This will be over. We'll get rid of these tariffs. Smoot Hawley, the 1930s, tariffs never work. They drive the wrong behaviour. They create inflation. Oh, inflation also created by the Iran war. And we had an over 4%, a 4.2% inflation print in the US, didn't we? And what did Mr. Trump say? Well, he didn't really have a choice. And when he doesn't have a choice, he always says something that you think as if he said that, you know. He said inflation. I love a bit of inflation. Love a bit of inflation. Brilliant, isn't it? You've really got to be full MAGA to love that one, haven't you? Or you've got to have lots of spare money. Or you've just got to own assets, enough assets such that you benefit from inflation, just like the governments do, rather than being a victim of inflation, which is the vast majority of the people, if they haven't got wages and other assets going up in line at least with inflation. And that means after tax money, not before tax money, apart from anything else. So has he managed, this is a question, a fair question, has he managed to actually get people to reshore in the United States based on these tariffs, even if from a monetary perspective it doesn't bring any net money into the US economy? Has it helped? Is the stuff coming home, just like football's coming home? Or probably not. If it comes home to the US, they'll have done very well. Why haven't they started the World Cup well, haven't they? What do you accept as evidence of reshoring? It's always a difficult one with Mr. Trump because White House announcements, are they evidence? I don't think they are they? They might be used in evidence one day. Let's find out. I guess we probably will. There's plenty of them, though. I mean, Apple, hundreds of billions coming in, Big Pharma pledging tens of billions of dollars each. A tin mill restarted in Gary, Indiana. If that's the bar we're setting, well, mission accomplished. But a pledge is not a poured foundation, folks. Pledges of investment are not investment. I always say this about surveys, ultimately. You don't measure intentions and then make policy based on stated intentions. If you do, then what you do is you start pandering to people who are clever and game the system and say, well, if you do this, then I'm going to do this. You have to base them on actions and also on historical precedent. And this is where politicians generally get it wrong. I don't know if it's because they can't be bothered to do the work. I don't know if it's because they focus on policy that sounds good rather than policy that's actually potentially going to change things. I don't know if it's because they don't accept behavioural economics. They haven't read enough Daniel Kahneman, Thinking Fast and Slow, and wonderful books like that. Probably a mixture of all the above, really, and the lack of competency in their shoes as well, of course. Those who can do, those who can't work in Westminster these days, don't they? Let's face it. But apart from Rishi Sunak, I should probably say, although what he couldn't do is be a great Prime Minister, which is unfortunate, right? But the question is, what's actually showing up in actual capital expenditure 18 months after the tariffs? Because that's pretty much what we are now. Guess what? That picture's a little bit thinner than the White House announcements suggest. Although we've still got, a few weeks till we've had that 18 months, haven't we? But we've got to keep watching this, and we'll have to watch over the course of years. And maybe in 10 years' time, I'll have to come on here, eat humble pie and say, God, Trump did it, didn't he? Forced those companies to relocate into the US just with that bluff of all the tariffs. Maybe he will. I'm not sure. Right? But where reshoring is happening, ultimately, it's being concentrated in the couple of sectors that were definitely expanding anyway in this environment. Semiconductors, I don't need to explain to you, with the world of AI that we live in, why semiconductors were going to be expanding. And also, in fairness, I should make the point at this point that it was pretty wise, bearing in mind the Taiwanese situation and the over-reliance on Taiwan and TSMC to be producing semiconductors that were now genuine strategic weaponry. Not just about making bigger, better, and faster computers, but being in and at the forefront of the artificial intelligence race, as the Americans are. Mostly because they're spending something like 20 times as much money as the Chinese government and the Chinese companies are on it. But ultimately, relocating stuff to Arizona when it came to chips was a good idea. But to be honest with you, off the top of my head, I can't remember if that was Trump or Biden that actually pushed that policy. But there is that strategic reason, a bit like not trying not to import loads of gas or any other fuels, if I'm honest, from anywhere else. We'd be better off in the UK if we had energy security, wouldn't we? But I won't digress into that one right now. So is he leading this parade, or is he standing in front of one that he really didn't organise? Well, I guess there is a bit of both, as there often is, right? The manufacturing jobs has been roughly flat to slightly down. He was promising to increase those because so much of his voter base is manufacturing or comes from a manufacturing background, family, lineage, etc., right? You wouldn't expect a reshoring boom to see flat or down in manufacturing jobs, would you? Now, are the tariffs really falling at every hurdle? Well, we know what happened in February. The enemies of the people, or whatever he called them, his own handpicked elected judges, half of them vote fast on him and turned on him and voted 6-3 to do their actual and proper job, which is uphold the law. But remember, the response wasn't to stop these tariffs. It was just that you needed to go to Congress. So what did he then do based on all of that? Well, effectively, instead of going to Congress, which obviously he could have done, he told his people to run off and go and look at the next tariff piece of statute legislation that he could use or try to use. I don't think these are being done with probabilities of success. If I'm honest with you, I think you stand in front of him and go, we can try this one. Let's give it a go. And he just goes, yeah, go on. Because he doesn't care about the law. The law is secondary to Donald Trump. He acts first. You know, he definitely takes, asks for forgiveness, not for permission, to a level 10 times above that, because he doesn't ask for forgiveness either, really. He just does. Ignore the law, just do. That's how he lived his whole life, ultimately. So the statute they're now relying on primarily is a temporary balance of payments provision, which is capped and time limited, like 15% max tariffs on a lot of stuff. Remember when he was talking about 150% to China? I think they were there for about 5 minutes or something like that around Liberation Day in April 2025, but there we are. So the quiet part out loud, the legal authority will change, but the direction of travel won't. He's going to keep this up as long as he can with those executive orders, probably for the 4 years of his term, and it's just going to be this constant snaking nightmare for businesses that get snared up in it. I really do feel sorry for them. They might get their money back in the end, but if you've gone broke, if you've let all your staff go, if you've lost your house, if you've lost your business, if you lost everything because you put everything into it, they're not going to pay compensation for all of that, right? It's not going to happen. And it's just tough luck being a little guy. Don't be a little guy. Terrible, isn't it, realistically? But that's where you end up. And then third lever that's important here is the money, right? And this is probably the surprising bit. 264 billion raised across 2025. That was about 4 times, for context, what was raised in 2024. So a 300% increase. That sounds like Donald Trump maths, doesn't it? But of course you can do 300% increases. What you can't do is 300% decreases, but he hasn't accepted that one either. Donald has his own maths, right? How much is 264 billion in the United States? More money than any of us could ever spend in many lifetimes. Less than a quarter of Elon's net worth, actually, as it goes, because he's had a pretty reasonable week with his slightly hooky SpaceX IPO, hasn't he? Selling 5% of the company off. Not sure that makes it particularly public myself, but there we go. All the early stage investors, I read the other day, Google had put $900 million in. That's now worth 120 billion. If you remember that money makes money, that'd be pretty good evidence. That's some return, isn't it? 130 odd X return. Not too bad. But that's where we are in the world. Does that touch the federal deficit in the US? Well, about 1.8 trillion in the red in terms of the deficit. Now, quick clarification of the difference in the debt and the deficit. The debt is what they owe. I think they're at about 37 trillion these days, but it all seems like fake money. So does it really matter that much? The deficit is the amount they're having to, is the amount it's getting worse by year on year, right? So it got worse by 1.8 trillion in 2025. And this is what you are, of course, supposed to, and this is what our fiscal rules state, is that by the end of the forecast period, the deficit, the direction of the deficit will start to reverse, and we will run what's called a surplus. It might be worth defining that one because we haven't had one of those since the late 90s, early 2000s, and depending on your political affiliations, I try to have none. What you point out is perhaps because the Labour Party came in and stuck to the Conservative spending plan that the Conservatives almost deliberately kind of choked the Labour Party with. A little bit like what Jeremy Hunt did when he knew they were going to lose the election when he ran his last budget. What was his last budget in early 2024? The poison pill budget, as I called it. We had other budgets over recent years that attracted a lot more attention than that one. Let's face it, but there we go. But it didn't touch the deficit, right? 6% of GDP, the deficit, a pretty damaging number, even after that tariff fall, and even after a one-off lump of student loan savings as well was added to it. But I didn't expect really to be writing that money would be being clawed back out of the door. And that's what I have been talking about in this week's full version. So when the Supreme Court struck the tariffs down, basically it said you can have some refunds. In principle, how much? About 166 billion. So 166 of 264, or about 60% already. And that's just based on that one Supreme Court ruling. Remember, it's a bit more complex than I've made out. Multiple bits of statute law have been enacted over the years. But that was money that about 330,000 importers paid and are now owed back with interest. That's where the 23 million a day comes in. But what's 23 million a day when you're talking about hundreds of billions? Well, still a fair amount, isn't it? 40 days is still $1 billion. Pretty unbelievable, realistically. But the interest is really the bit that's going to make you put that coffee down if you're listening to this live. The government held money it was never legally entitled to. And because of that, it does pay interest on the way back. That is precedent that is set. The running cost of the delay is that 23 million a day. The money that supposedly fiscally responsible option should never have taken if they'd looked at a cost benefit analysis, probability of success, all the boring bits of policy that is boring, but it just gets in the way to Donald Trump, so he doesn't do it. And this is the sort of thing that ends up happening, even when he's packed the Supreme Court with theoretical loyalists, right? The checks and balances do seem to have worked on that one, right? And it's actually happening. This is not theoretical, right? The customs in the US has built this refund system from scratch this spring, and as of the first week of June, they had accepted nearly 95 billion of claims so far and pushed getting on nearly 24 billion back to the Treasury to pay out. So they're getting on with it, right? And it's being fought every inch of the way, of course. Department of Justice is arguing only those who've actually sued can be refunded. So if you didn't enter into a class action or you didn't do it yourself, I remember class actions are really there for private individuals. They're not there for companies as a general rule. So if you didn't sue, they're trying to say, didn't sue, don't get your money back. Many will have sued though. This is America, folks. They sue, right? All the time. But ultimately, the judge in that case hauled the head of customs into court on the 9th to explain why these repayments have been so slow. So this is very much up to the minute stuff. And then what's the kicker? Well, of course, this replacement tariff, the 15%, can't be on more than 150 days. That's in the statute books. And guess what? The precedent of appeal has now been set. So this one is also being appealed as well. So I'm sure they'll go again and move the chess piece again. It feels like they move the chess pieces sideways in these situations, not forwards. But that's where we are. But put all this in one place, ultimately enormous sums have been raised. The deficit has not been touched. 166 billion back out with a daily interest penalty, a replacement mechanism with this short fuse in the courts. I don't think Mr. Trump can call this winning. But luckily, he's sick of winning. They're all sick of winning. They've been in so much winning. They're just so sick of it, apart from anything else. Expensive is probably a better word than winning, I think, realistically. And translate this back to our mortgages, gilt yields, things like this. This is not clean resolution stuff. It just sits there as a permanent hum of what's next. More uncertainty to investors. Does it help them to get this money back? Would they have wanted it to be this way? Of course not. They would have just preferred not to have made the changes, whatever changes they have had to make in the first place. They're going to get the tariffs back. They're not going to get the money back in terms of the time that they've burnt, any resources they've invested in contingency plans. What if people have bought sites, started to build them, worked on planning, all this other sort of stuff, all impacts the bond market. And that has a hum, even when no single case does, right? So what about Kevin Warsh, the new chairman of the Fed? I know I'm banging on a lot about the US, but it has been one hell of a week this week, so we've got to. Trump's man, right? He's got his man in position, much better than Jerome Powell, who he spent a lot of time slagging off. So what's the framework, realistically? He's sworn in 22nd of May, the 17th chair of the Federal Reserve. The confirmation, 54-45 in the Senate. The single closest vote in the modern era. Got very political. Rightly so, you would think, but not good, is it? Remember the independent central bank? That makes it look completely dependent from a Republican perspective. It's very similar to the current the current split in the Senate of Republicans versus Democrats / independents, right? Jay Powell, really unusually, has stayed on the board, so he will actually sit at the right hand of Kevin Warsh. I don't think that's a bad thing at all. I think he's doing the right thing. I also think there'll be an element of which some people are saying to him, show them that you're a cut above Mr. Trump, right? Be the bigger man. Does that work with the Donald? Don't know. So where are we at? Well, US inflation had this 3-year high, as I said, 4.2%. Labour market, low hire, low fire. So not a lot of people losing out their jobs, but not massive jobs coming in. But the US economy, the big machine, is still adding the jobs. Just like the UK economy, even when there's some idiots in charge, it keeps calm and carries on, right? The April predecessor meeting, the last meeting of the Federal Reserve, had 4 dissents, right, which was the most disagreement in decades. The Americans are much keener. The British, the Bank of England, are quite happy to show a vote that was 5-4, or there was even that vote that was 4-4-1, and they had to have a re-vote, first time the bank have ever had to do that. They don't worry about it. They believe, and I do agree with them, that it shows that it is a genuinely healthy and independent system, right? And we haven't all got nodding dogs around a table. We've got the complete opposite of that. And I do think that the Bank of England Monetary Policy Committee does do a good job based on that. And it does a far, far better job than before the Bank of England was independent. And I've said it before, can you imagine the problems if the Bank of England hadn't been independent when Liz Truss was the Prime Minister and Kwasi Kwarteng was the Chancellor? Goodness me, it makes the hair stand up on my arm just thinking about it. I just can't fathom what really could have happened then, because it could have been way, way more problematic than it already was. And the market is at 97% likelihood in the futures that the Fed will hold at 3.5 to 3.75. They use a range in their target funds rate on this Wednesday coming. So the rate's not the story, but the framework is, right? Warsh wants to tear up 2 things that the Fed has lent on for 15 years. Detailed forward guidance, deemed largely to be a success when Mark Carney implemented it at the Bank of England, and the dot plot. You may have heard of it, you may have seen it, but this is where all the people on the Fed committee are asked to put a dot of where they think the rate will be in various periods of time, including going ahead years. So the dot plot shows you just quite how on the same page they are. What you don't want to see is an hourglass of people with extremes, right? Lots of dots at the top and the bottom and thin stuff in the middle. You want to see consensus, realistically. But this is where it shows you they still have independent thinking. It's quite clever, the dot plot. I think it's a good thing, right? So these 2 good things that I can't find many reasons to say why we should tear them up. Why get rid of them apart from anything else? The dot plot is actually called, by the way, the summary of economic projections, but it all gets called the dot plot. Why? Well, forward guidance apparently compounded the transitory blunder of 2021-22. So what's his point there? And let's examine it a little bit. Well, what he's saying is, because we said we were going to do this, we then did it anyway, even when we knew it was the wrong thing to do. And ultimately, even though I said transitory inflation was a complete lie at the time and said that for a long, long time, I thought my beef was this was the wrong reading of the market and what was going on the supply side, right? Now, the Bank of England, when they explain it post hoc, they say, well, a consideration was also that we had to manage the risk of the rates going up, of inflation going up even more than it did, and therefore we had to get ahead of it with the rates. We didn't get ahead of it in the UK. That's wrong. That's a lie. I remember hearing Andy Haldane, the chief economist at the time, it was the bank for the thick end of 30 years. And he was in the middle of 2021 saying, we're going to have an inflation problem. I've been saying that since February in 2021. So obviously I agreed with him, but ultimately the committee did not agree with him. And that argument did not cut through. So we didn't get the rises that we should have in time. But the risk management argument is a very good one. That doesn't go away. And because there are probably more similarities than usual in the supply shock created by the Iran war versus the supply shock created by the pandemic. I don't think, I mean, Warsh is obviously saying we stuck to it when we shouldn't have done. I'm not so sure they shouldn't have done. But of course, it's very difficult to prove or even theorise against these counterfactuals because the events played out as they did. We can't go back and say, well, what if we hadn't put the rates up at all those meetings in 2021 and 2022? We don't know. We don't have the economic data on what would have happened. Inflation in the US might have been double digits. That might have caused all sorts of problems. Once you get above the target and then double above the target, when you're at the 4% of the world and things like that, that's when it starts getting salty. If you remember, we went up to 11 plus percent, 12% in the UK. And the smallest little thing at that point in time could have taken us to 20, and then you're not far away from inflation. It didn't happen. And the government were absolutely committed, and the Bank of England was committed to making sure that didn't happen. Just think back to the energy bill scheme that was used to say, right, okay, we are going the cap, 70 billion, about the same cost when it was theorised as what furlough cost during the pandemic. And that's a comparison I very, very rarely, I've never actually heard that comparison raised before. But think how important a policy furlough was. And I was a big supporter of furlough. Not that I have the joy of going on furlough, of course, got too many things going on to even remotely consider something like that. But ultimately, creating jobs costs an awful lot of money, tens of thousands of pounds a job. So if you can stop losing those jobs, furlough, something like furlough is a drastically least worst solution. And Sunak not giving enough credit for furlough. Instead, he's given a hard time for Eat Out to help out, but that's typical politics. You know, a couple of billion quid versus 70 billion. That 70 billion probably saved us multiple times that, 3 times, 4 times that in savings of what would have happened if furlough hadn't been there. But nobody ever talks about the stuff that works. The politicians just get a hard time, right? So why does he want to get rid of all these bits in the Fed? We need a leaner Fed that says less and commits to nothing. Well, this is directly flying in the face of the Ben Bernankes of the world, who say central banking is 98% doing nothing but communicating and 2% action. Right, you want one that communicates. It's extremely important they communicate. One that keeps themselves to themselves. Fewer press conferences. He wants shorter statements, no dot plots. Strategic ambiguity is the phrase that's done the rounds, and I love it. Right, I mean it's a genuine philosophical break. Right, it's a tweak. Is he right? Well, as I say, little bit of sympathy for the diagnosis because, as I say myself, there was no way it was transitory inflation back in 2021. Anybody could have told you that, but his cure for this is the worrying part, right? Markets price risk. Ultimately, that's what they do. Investors don't like risk. If there is risk, they want massive returns apart from anything else. And the central bank deliberately is calming them down on the risk front, right? It tells them less does not abolish uncertainty, transfers through into everyone else. So there's more volatile bond markets if this happens. That's not good. Mr. Trump's tried to intervene with the mortgage-backed securities already, and what he did lasted about 5 minutes when he talked about $200 billion worth of bonds, if you remember that from back at the start of this year. Now, he also leans heavily on AI-driven productivity as a powerful disinflationary force, which is basically him saying, and then look, is that possibly true? Is it even deflationary? Well, one of the things we know, don't we, over the course of the last 50 years or whatever, I was talking to someone the other day who had bought one of the first Texas Instruments calculators for a child at the time, and it was something like £100 or something like that. And we're talking about the 70s here, so that would be, you know, hundreds and hundreds of pounds in today's world. Instead, calculation is free, and buying a really 1,000 times more powerful scientific calculator probably cost you about £6 in Argos, right, apart from anything else. So that's the reality of it. AI will be disinflationary at some point in time, although there'll be lots of people fighting, apart from anything else, to get the money back that they've invested in AI. So as and when will the prices come down? But of course, pharma which is, maybe doesn't fill anyone with glee. But pharma works in this way. R&D on a drug, massive, and there's huge tax breaks for all of that, of course. And then they make the money back over the life of the patent. The problem here, no patent, really, guys. So how are you going to do that? But this is one of the challenges the AI industry will have to face, apart from anything else, right? So he says, cut without reigniting inflation because AI will sort out deflation. Possible, unproven, timing not in control of. So this time productivity changes everything. I'd love to think it's the case. And look, AI is just utterly incredible. I can do so much more thanks to Claude and Gemini, and other models are available, of course. But there's just no way. This is pipe dream stuff. It's not evidential in any way, shape, or form, right? When will the robots be cutting everyone's shopping bill and doing everything for us? Might take quite a long time, right? For 3 Sundays in a row, I've been tracking this handover because it's so significant. Warsh sworn in with Trump, telling him, just do your own thing. Great guidance there, right? And then earlier on in June, the hawkish turn. Inflation is not headed in the right direction. That's what he was told in his first proper week. But what's the consistency here? An independent central bank will be a captured one. And ultimately, the market at the moment, correctly, is pricing in the risk of capture into US Treasury yields. And this is the sort of stuff that Donald Trump just doesn't understand. Ultimately, this is where people who love the market get turned over by the market. Exactly what happened to Liz Truss as it goes. Okay, let's bridge back towards the UK and the UK property market with a little bit of chat about the Makerfield by-election and Andy Burnham. So Thursday, same day as the Bank of England meeting, one's going to overshadow the other. I strongly suspect it with the Bank of England meeting that doesn't make any headlines, because I'm looking at a hold on that one with a large amount of certainty. But one Greater Manchester seat, there'd be a bit of action, wouldn't there? Probably be a reform win. I think it'd almost certainly be a reform win, actually, the way things are at the moment, if it wasn't for Mr. Burnham standing. He's a front runner to replace Starmer if he wins this. Now, what could happen here? It could be, I did hear a theory, the Boaty McBoatface theory, that I quite liked, actually, that people in Makerfield might just vote differently in order to up in the apple cart and stick 2 fingers up in that British way. I hope they don't, to an extent, because, don't get me wrong, if Starmer stayed, it wouldn't be the end of the world. But Burnham not getting in doesn't mean Starmer stays, does it? It means that all of the other MPs find someone else to do it. And I think, how I think that someone else might be. And if you don't, let's just say she didn't pay all the stamp duty that she should have done. I think you can work that person out for yourself. Prepared at the Property Mark conference this week. Not given a hard time by the person on stage. So just collected a nice fee, I'm sure. Probably enough to pay the stamp duty, to be honest. But there we go. Not after tax, due to the excessive tax that her government puts on anybody who dares to earn any money, apart from anything else. But there we go. So if Burnham does win, have we got looser fiscal policy? It certainly feels like it. It'll make a massive difference on the basis of the Chancellor that he elects, if he's in, right? And there's such a big range of people that he could elect as Chancellor, all the way from Torsten Bell's probably the most left-leaning, former chief exec of the Resolution Foundation I've talked about before, all the way out to Pat McFadden, who was the one who was in the Epstein files talking to Mandelson about how depressing it was that every conversation he had in government was, how do we get more tax out of people so we can redistribute it through the benefit system? Which, as I said, I seem to be the only one who said I wasn't surprised by that at all. Ultimately, that is why you're in the Labour Party. Not Blue Labour, not the right wing of the Labour Party, but that is why you're in the Labour Party, I would have thought, to redistribute. And if you voted for the Labour Party, that's what you should have been expecting, because that's what they do, redistribute. And if it was done well, don't say it out loud too loud, folks, it wouldn't have been a bad thing, right? But there we go. So this was the open challenge, which we all knew, the worst kept secret in politics, came out sort of a few weeks ago when Burnham confirmed that he would stand. It's all in on Makerfield to get him a seat. Could he have another go if he fails in Makerfield? It would be a bit of a joke, wouldn't it? In theory he could, but goodness me, that would he'd be beat before he started, I would have thought, if he can't win this. What I said last week when I talked about this was the other shock news of the week was the Pope is Catholic. Starmer says he's going nowhere. That's what he does. Generally speaking, he's been quite resolute, and he knew that he would need to be. And I think actually most of us can find a little bit of admiration for him in that bloody mindedness. But we just think he should go because he's rubbish, really, and he's not up to the job of being the Prime Minister. If he stayed, most business people, large percentage of business people, want him to stay for the stability reason, and that also makes some sense. Hopefully we would keep calm and carry on. I'm surprised no one has used the gags that I've seen anyway. King Makerfield, that's a good name for this by-election. Or for those of you who are fans of the Running Man, the old 1980 Schwarzenegger version, the Butcher of Makersfield. Ben Richards, or will it be Andy Burnham, or will it be the Reform candidate this time round? Let's find out. Or will count bin face surprise everyone? Probably not, folks. But again, why do we care about this stuff? What does it matter for your terraced house in Leeds that you're letting out? Well, apart from anything else, we've got that Bank of England meeting, right? So Federal Reserve will have their 2-day meeting, then the Bank of England meet with that same, usually the old follow the Fed logic, which I don't follow as much as anything else. But ultimately, we are dealing with a lot of similar things at the moment. The same war, the same shock to energy prices, although obviously energy prices are a lot higher in the UK, and that same hawkish drumbeat. Megan Green openly floated a hike if Iran drags on. So where will the war be on Thursday? Well, let's see. We'll talk about that very shortly. Before we get into Threadneedle Street, we're going to get onto the real high street. So the real-time market and Chris Watkins figures for what's week 22. It's bread and butter stuff, and for me, it's my chance to geek out over the stats for the week. Chris does a show every week on YouTube, and also the article gets published on Property Industry Eye and via his LinkedIn. Whilst Chris's main audience is estate agents, ultimately, his data is phenomenal. His grasp of stats is very, very good, and it's brilliant to have someone to pump all that stuff out there for us for free. And the point is, I read it so you don't have to get into the graphs and the numbers if you don't want to. But I'll give you the 419 as a general rule. So, supply-wise, flow versus standing stock. This is an important distinction that I made this week, right? 38,900 new properties to market, nearly 40k again. It's a huge amount of properties hitting the market, right? We had 31,000 last week, but ultimately it was the bank holiday. So don't worry about that. You're going to get a bounce. You have one fewer weekday, ultimately, 20% fewer weekdays in a week like that. And then year-to-date supply pipeline, 823,000 listings, 0.5% ahead of last year, nearly 6% ahead of 2024, 14.5% above the old norm before the pandemic. So massive number, 823,000. But this is about the new supply, right? This is what's flowed in to the market since 1st of January. It's not what I mean when I'm talking about there being 10% more stock on the market than usual, or maybe even 15% more. That is the entire supply, the standing inventory. So what do I mean by that? Well, some of those houses that have been listed this year have already been sold, have completed, and the transaction is finished. Superb, right? Great news. Not many, I dare say, but some of them have. Some of them have been mine, actually. So there we go. So I know that some of them have. Some of them were still on the market and were listed last year, and they're enduring that death by 1,000 cuts trying to get them sold. Some of them are sitting there on the market, sold subject to contract, which will be a future fall through or not, possibly. So we'll see where we are. But I'm talking about what is standing on the market. How many houses are on the market at this time, right? So we've been following that, and month to month, they have been monthly new highs, new 11-year highs, apart from anything else in terms of what's sitting there, not clearing out on the market, because we've had so much supply. That has been the driver. Not enough demand to clear the excess supply. That's the way to look at this market. That's the real truth of what's been happening. Where's the excess supply come from? I've said many times, folks, it's coming from landlords looking to exit. Does that mean that's not a rental unit anymore? Not necessarily. Vast majority, certainly 6 out of 7 or similar in places where I've seen the data available, have been bought again as rentals. Some people have quoted much lower figures than that, but ultimately we're not seeing this drastic drop in figures that we thought we would do. So that's where we are. Ultimately, this pre-pandemic norm, we would see high 20s being in an estate agency window. Per branch, this is number of listings as a general rule. High 20s was their stock number. 2022, when stock was really, really short after the pandemic, early 2022, there's about 15 per branch. There just wasn't enough on the market. That's why everything was flying off the shelves. Still only completed about 67% of what hit the market, which is just outrageous, really, when you think about it. Where are we now? Well, we're in the low 30s per branch per year. So you can see the comparison there. So it is something like 10 or 15% more standing stock. I already reckon it might be more like 20%, to be honest. Imagine if the old norm was 27, then you only need to get to 32 to be 20% higher than normal. So it's probably 20% plus, actually. I might need to start saying 15 to 20% plus over coming weeks. So there we are. We're not seeing listings slow down at the moment, as I've said. But how much is fresh and how much is stale? Now, when we go into this year, about a third of the homes on the market had been listed before, pulled out and put back in. People who withdrew during the budget jitters, especially when nothing over 500 grand was selling, because we were all being told there's going to be an issue here, and we're going to get taxed on houses that are worth over 500k in a different way or something like that. So there was a speculation that caused a bit more jitter than before, but stock is genuinely elevated, but it's not fresh choice stuff necessarily, right? So what about demand? Because this is where week 22 really does show us something interesting, or cements a bit of a trend that we've seen before. Gross sales 25,600 for the week, above the 10-year week 22 average of 20,500. So still about 10% above that, or near offer. On the surface, absolutely fine. Year on year, gross sales agreed in the first week of June down 8.9% on the same week in 2025, and down in every single region of the UK. Not one single region bucked it. Scotland nearly did, minus 0.6%. Northern Ireland down nearly 50%. Don't worry too much about that, because ultimately the numbers are very small in Northern Ireland, and there's been some stuff going on in Northern Ireland over the past week or so that you might also be aware of, so bear some of that in mind. But outer London down 18.45% year on year for the week. Inner London down 13.12%. Yorkshire and Humber are only 2.06% off. But you can see that average of 8.9. This is not the old two-tier, it's all London, because actually the southeast amount of sales agreed was not down materially much at all. It was about 3%, if I remember correctly. The Midlands was stuck about 7, 8, 9%. The northeast took it, the northwest took it, all of these hot regions. Northern Ireland, this incredible hot region, also took it, right? It's softening. It's definitely not uniform, but it's softening, right? Definitely softening. And it's not all about cheap and valuable houses as it has been. So what does it mean from a textbook perspective? The market is getting more selective. It's not collapsing, so don't worry about that. Year-to-date gross sales, yes, we are down 5.8%. Now, we did have that stamp duty change in the 31st of March, but we've had a couple of months since the 31st of March, folks, so it's starting to nearly iron it out, really. I'd say you need to get to sort of July, August time to really have ironed out that pig in the python, if you like. 2.1% ahead of 2024 in terms of year-to-date gross sales. That's probably the figure that I would rely on a lot more than the disturbed 2025 market. We're only a bit better than 2024, which wasn't a terrible market. In fact, house prices were up about 4%, according to the ONS in 2024. So do bear that in mind. Not too bad at all. Only 2.1% ahead of that. 12.4% ahead of 2023. That was lettuce recovery year. You might remember it. So 9.6% ahead of the pre-COVID average. So we know there wasn't as much stuff being listed. People were, I think, also having a think post-Brexit about what might happen and thinking about other things in their lives that were relevant, and tended to hold off the market a bit more. So don't let the doom mongers gather around the doom fire, as Chris has said this week. It's a functioning market transacting at healthy recent historical volumes. It's just been a bit fussier, right? Net sales 19,700 versus the week 22 average of 18,100. Year to date net 427,000, 4% below 2025 6.9% or 7% above pre-COVID. So think about those 5 Ds that I talk about regularly: death, debt, divorce, downsizing, and diddy ones. Ultimately, just plug away regardless of what the orange man has tweeted overnight. Plus, you can't keep up with 284 truths every evening or whatever, can you? So where's the friction in this marketplace? Well, I've talked over recent weeks and months about this gap between the average listing price, 452,000 for the week in question, and the average sale agreed, 374,000, 20.8%. Now we've seen an intergalactic 27.4 earlier this year. So we're a bit closer to the old norm, which is more like 16 to 17%. Still ridiculous. Much more like 10% in sensible parts of the country, and way more in London and the southeast, where agents just violently over-instruct in order to get business. It really is absolutely rife, and it is an embarrassment to the industry, to be honest with you, but that's where we are. Now, reductions, 28,000 this week. That's big. That's one of the bigger numbers I can remember for a long time. 13.4% of all stock on the market was reduced in May. 2025 average was 12.8, so not drastically different. Longer run average 10.7. There's more stock. We're having to reduce more aggressively in order to get things in front of people to make them think they've got a bargain, or to give them a genuine bargain, or perhaps just to sell them the house at the right sort of price in the first place, rather than messing around trying to nick an extra 5 or 10 grand that the value isn't there for, or 25 grand, or 50 grand. There's a house locally that's been dropped from 2.25 million to 1.75 million, but the 2.25 was a joke price in the first place, used as an over instruction. Caused a bit of fuss locally on social media this week for people to keep an eye on those things. But the agent in question, in my opinion, should stop over instructing stuff so aggressively, because it's not good for their clients, not good for their vendors. It's a disgusting practice, to be honest with you. Appealing to greed, ultimately. So you could say, well, not the agent's fault, it's the vendor's fault for being greedy. But you call professionals so you can trust them, right? Not so they can con you into signing a 26-week contract or whatever to keep your house on the market with them. So the withdrawal number that's been making people wince all over the place, 45.5% of homes leaving agents' books in May went unsold, nearly half. Fall through rate behaving, 23%. It's below that decade-long average of 24.5. What are we saying? Deals that agreed are mostly sticking. We're losing fewer than 1 in 4 deals at the moment. It's a horrible rate. It's still a horrible rate in broader context. Still sounds like a ridiculous number to me, but that's where we are. Better than it has been, marginally, right? Why does this happen? The corporate business model rewards the listing. It doesn't reward the sale. Listers are getting bonused on putting houses on the market, not enough on getting them over the line, right? These horrible long sole agency contracts are there to protect the agents, not the sellers. Just the same toxicity week in, week out. Chris talks about it plenty, and he's dead right, right? Now, what was the bonus content from what Verona Frankish and Chris talked about this week on the show? Right, despite all that softening in the volume, the average price achieved per square foot rose from £343.77 a foot in April to £349.64 in May, a 1.7% monthly increase in actual achieved agreed values. So year on year, that's only 1.9, even though it's 1.7 in a month. Chris doesn't seasonally adjust that figure, I should say. So that does make a difference. Normally that would be seasonally adjusted if we were looking at a Rightmove or a Zoopla or an ONS style report, which I prefer the ONS to the aforementioned sources because they have all the data. So some of that is seasonal, right? But still, bear in mind, it's a big amount, right? In the last 5 years, the price per square foot has only gone up 13.2%. But of course, if we go back 5 years from where we are today, well, right 5 years ago, June 2021, massively warm market. A lot of that 13.2 was achieved probably between June 21 and June 22. And of course, some of that period, right, certainly post-lettuce throughout 2023, prices were actually falling as well, nominally. We're talking about not inflation adjusted. So do remember that, right? So fewer homes selling, but the ones that do sell are achieving more per foot. So obviously not a collapsing market, obviously a selective one. Price it well, present it well, they're still commanding strong money, because guess what? They're still extremely desirable, and they'll still sell well to people who are motivated to move, right? Now, I've said this before, but it's worth repeating. This pounds per square foot index has got an incredible correlation with the land registry, 98% accuracy, roughly 5 months ahead of what hits the land reg, right? Because this is the sold subject to contract agreed price. Yeah, it's not the completed price. So we do need to bear that in mind. But 98% correlation is the stuff of statistical legend, to be honest with you. It's not about the 1.7% being accurate, because it's not, right? It's the direction of travel that we're correlating in. It's not the quantum. So also bear that in mind. But this is so much stronger than any headline asking price index you see in any of the papers. You can't believe it, right? So that 98% figure I use very, very regularly because I'm so impressed by how significant it is, right? Who's predicted 2% for the housing market this year? That was me. Didn't predict the war, didn't predict any of that. And of course, we're talking 5 months in advance, and we've been talking about May's numbers. So that's October's numbers, not December's number. So let's see, before I celebrate too early. Likely to be clipped a little bit, I might suggest, based on what we've seen. Let's see what June's number comes in at, and let's see what July's number comes in at, ultimately. What about the rental side? Well, it's tight. We know we've had hardly any rent increases in terms of new asking rents in the past 12 months. It's basically flat year on year. But when I look at the average rent of what's listed at £1,785, and again, that's the average rent of what's listed, not the average rent that people are paying. So if there are more high value units on the market, for example, in London, because there is still a fair bit of supply, why is there so much supply if everyone's selling up? Because they can't sell them, and then they yank them off the market, and then they re-rent them again, right? This is a cycle that's going through in the excess landlording stock, and also, frankly, in the owner-occupier market. If someone says, well, we're moving out of London for another reason, it's time to do so, this, that, the other, they hold on to their flat. This is exactly why people like Rachel Reeves' husband has got another flat in London, right? They moved out to a bigger house that they also now rent out at the moment, while they are renting or being gifted their residence in 11 Downing Street off the state. Not much longer to go on that one, and I'm going to be watching with interest when Rachel Reeves serves ground 1A against her tenants, asking them to move on because she doesn't have somewhere to live anymore if the whole Makerfield thing plays out as we think it probably will, right? So, supply unchanged year on year, 305,000 rental properties available, 311,000 a year ago. So this structural shortage or whatever, or people running away and not being the units, it's not playing out, folks. It's not playing out, and it's not playing out for some of the reasons that I said. The other side of it is new units are being created by larger corporations who are absolutely loving buying while prices aren't going upwards or are going downwards, or there's uncertainty in the market, right? So I explained why headline rents look flat last week, right? The tenant base has hit its affordability ceiling on a lot of that sort of stuff. And the Resolution Foundation did 30 pages of evidence behind that ceiling that I summarised last week. And the era of above inflation rent rises doing heavy lifting is over in much of the country. Having said that, do we need inflation plus when inflation is bound to be in the 3 to 4% region? No, we don't. I'd take inflation every year from here on in for the fullness of time, very, very happily, and so would any sensible institutional investor. An investment that gives you inflation protection is more than worth its weight in gold. What can you get from investing in a gilt, a government bond that has inflation protection in it? You have been able to get 2% on top of inflation recently. Again, that's an incredible deal, I think. But those linkers, as they're called, inflation-linked bonds, sometimes trade below that. You might get 0.5% less than inflation. It really depends. And so that's faith in the UK and its financial model, apart from anything else. But it doesn't matter what you can say. As a landlord, you can say, well, I've got these costs. I've now got selective licensing. I've got this, that, the other, blah, blah, blah. If a tenant can't afford it, you're not going to let it to anyone. And what happens in the real world that we see these days is you get 30, 40, 50 applications for a property, and only 3 or 4 of those have got half a chance of being able to afford it, apart from anything else. Now, you can't skim off that level of tenant and leave the other 40 to 45 not being able to afford anything without there being a longer term fallout of that. And you do wonder where and how those people get housed. And the answer usually is by a housing provider in the end, at least for some of them. But that's where we are. So always want to give Chris a bit of love, bit of appreciation. His YouTube channel is youtube.com/Christopher Watkin. Drop him a thanks, drop him a like, drop him a subscribe, watch a few of his videos. And if you're a property professional who wants to improve their local market presence, then Chris is the man to help you with that with his ghostwriting skills, apart from anything else. So please send your friends to his channel, share his content. This is the reciprocal piece. Chris doesn't pay me for saying any of this. Massive fan. Thanks for what you do, Chris. And I'm looking forward to the next time I'm on the show. Hint, hint, mate. Thanks very much. Okay, into the macro. We've been cracking on now for a long time, but we've now got to get really into the meat of the whole deal. So, first up, GDP, growth. Growth. We love a bit of growth, don't we, if we've got any. Construction and the war in the data, I've called this section, right? So, monthly GDP, oh my God, it was down, contracted, it did awfully badly. It was down 0.1% in April. And that's the first monthly fall since August 2025. We had a plus 0.3 in March, a plus 0.4 in February. So the run of form had been pretty good, overperformed, to be honest. And we know we had pretty disappointing looking PMIs relatively recently. They don't tend to track month to month with the ONS figures, which is annoying. But I prefer the PMIs because we get them faster and they are ultimately from the private sector that drives the economy. But the ONS is going to have all the data. And one of the things I said with this Labour government and why there wouldn't be a recession is all the bits that the private sector were moaning about that we couldn't see, the public sector was expanding. And it did. And that's what's driven a lot of the growth that we've had since they took charge on that fateful 4th of July in 2024. Three-month on 3 month is still positive, plus 0.7% growth. And that's the 5th consecutive 3-month on 3-month rise. The largest contribution, a solid plus 0.8% in services over the quarter. 1.2% bigger than a year ago. I've said we're in a 1% economy at the moment with the sort of chokes we've got placed on it from a policy perspective by the government in their wisdom. So treacle, I coined this word for this economy back in 2023, and very little has really changed in economic reality terms since then, despite all the political fuss. We keep calm and we carry on. It's what we do, folks. So the 0.1% drop is actually driven completely by services. It dropped 0.2%. That's fairly significant. Production was flat and construction edged up 0.1%. And that up is doing something sneaky, but we'll come back to that in a bit. Within the services, the ONS points to weaker public administration and arts, entertainment and recreation. So some of the recreational weakness actually ties to the Middle East. Cancelled events, disruptive events. People couldn't fly, for example, for a while. That fed into UK businesses. But the public administration piece is very much a domestic story, not a war story. The war is one ingredient. It's not the whole recipe here, folks. So let's not pin a 1-month wobble entirely on Tehran. There's more of a smoothing out effect of a fairly good start to the year. A start to the year that, to be honest, was far better than anybody had predicted. It really surprised the economists, even though we'd seemed to do very well in this first quarter of the year when you look back at the historical patterns. Manufacturing grew 0.4 in April, which was the largest single positive contribution, was a 4.2% surge in basic pharmaceutical products, which is our second strong pharma month after plus 2.1 in March. Well, why is this? Well, it actually chimes in with Trumpwatch, right? Pharma, chips, AI, demographics winners, not broad-based reindustrialization. So what I'm saying to you is we see the same pattern we've seen in the US numbers that Trump is trying to claim as reshoring victories for tariffs in the UK GDP figures. So isn't that interesting and convenient and lead to potential conclusions? And construction, where that innocent 0.1% is hiding the actual story, that growth was all in repair and maintenance, which was actually up 0.6. New work, guess what? Down 0.3. So forget about the 1.5 million homes if you haven't already. I'm sure you have, right? But it's the only thing keeping construction positive in April was patching up buildings that already exist. The buildings and new ones went backwards. Real estate activities barely moved. So if they say construction grew in the government, it's not what construction companies I know, especially those who deal with the primary market, are seeing at the moment. They're seeing much more struggle after struggle after struggle, right? Now, the PMIs, right? The 38.2 print for May, which is just so horrible. I mean, it was already 39.7 in April. bear in mind, below 50 is a contraction, below 45 is a problem, below 40 is black armband territory, right? We had that sharpest fall since May 2020. And if you go back, you have to go back to the financial crisis to find another one with all of that. We're not in certainly a recognised crisis anywhere near as bad as the pandemic or the GFC, but construction is really, really struggling. 17 months in a row of contraction. House building, the weakest sentiment. New orders falling at the fastest pace in 6 years. Terrible stuff, right? Put the ONS growth report side by side with the PMIs, and ultimately the sector that needs to expand to fix the problems that there are is contracting. That's where we are. The costs are rising because of the war. The order book is shrinking because the clients are frightened, the investors are worried about volatility, risk, prices drifting up during a build. Sensitivity analysis is a problem at the moment, and people are just not getting involved in it. Right, it's week on week, it seems to be the same story at the moment, but a different gauge and some new data backing up and reinforcing that position even further, right? The May PMI in the 17th of May, I talked about the flash numbers, construction crashing. 7th of June, the GDP detail I talked about. Today we've got new work falling again, and the PMI ultimately confirming it. This is great financial crisis grade output in the sector that's going to build 300,000 plus homes a year. We're just in a completely different postcode, realistically. Okay, next up is the RICS residential market report. I always look at this one every month, and the first flicker of hope in a while. This is not a publication to read, folks, if you're expecting to put a smile on your face or to enjoy it very much at all. You're really not going to. It's pretty miserable stuff, the RICS residential market report, but that's where we are. Right, now, new buyer inquiries, net balance, minus 34%. A quick word on what the balance figure means. It takes the number of people following. So if 100 people responded to the survey, what minus 34 would mean is that you had, let me do the maths, 67 saying that new buyer inquiries were down in their branches and 33 saying they were up. So you would start at minus 67, add back on plus 33, and you would end up at minus 34. Minus means in more cases it's going down than it's going up. Plus means it's going up more than it's going down. I hope that's helpful. So sales agreed, minus 37% on the balance numbers. No one can pretend any of those are good numbers. But the deterioration has stopped getting worse. And that's your flicker of hope that you're going to get for me in this report today. New buyer inquiries unchanged. First time it's not fallen since January. Surveyors framing, the recent deterioration may be starting to stabilise. They're always careful. That's what they do. They do it for a living. They hedge their bets. What's the analogy here? The patient has stopped losing blood. That's not the same as the patient getting up and walking off the operating table, right? But we'd rather have a steadying of the pulse than anything else, of course, if we're not going to suddenly have a Lazarus-style recovery, right? 12-month view, surveyors net positive on prices over the year ahead, as they often are. So the longer-term horizon has held up quite well, despite some of these short-term wobbles over pricing that we've seen in recent months of the residential market survey report. Regional split, I've talked about it so many times. You know what I'm going to say. Where are they expecting falls? London, the south, southeast, and East Anglia. That's it. Where are they expecting to do well? In order, Northern Ireland, Scotland, the northwest, ultimately. Bifurcated, two-tier market, call it what you want to call it, right? Rent's absolutely the mirror image. Tenant demand positive. Landlord instructions deeply negative. So that's landlords who bring their properties to agents to rent out. That's just going down and down and down across the board. Does that mean there's less rental stock? This is the bit where you have to be cautious because you can't ultimately immediately draw that conclusion. What you might have to conclude is margins are really thin at the moment, so people are being forced into taking their own stock off their agents, even though it's a terrible, terrible time to do that with renters' rights being in place. The worst time you could have picked in 38 years to do that, I'd suggest. But if you have to, or you're going to get it repossessed and you can't afford to pay the mortgage, what you going to do? You got to do the work yourself, haven't you? Ultimately, that's where you are. So good luck if you are doing that. As I say, definitely not advisable from a Propenomix perspective, but there we are. But the observation that is worth airing here ultimately, right, you know, we've seen 75 odd of these in a row I've looked through of these RICS residential market reports, right? It seems that they are quite well describing the inflation adjusted market when it comes to prices, rather than the nominal priced market that everybody in the UK insists on talking about, that the Guardian talks about, that the Telegraph talks about, that everybody in the middle wants to talk about, right? Affordability is a short term problem, yeah? And the short term is exactly that, it's a short term time horizon. In the medium term, people's pay rises depend partially on their inflation expectations, which is a nice little segue for us over to the next bit, which is not something I've been able to analyse in the supplement before. I'm excited to say today I can bring you because of a little gap, because of the way the macro calendar has worked. Next week it's wall to wall, right? And the week after that we'll be catching up on what we couldn't talk about the week before. But a little opportunity has arisen to talk about the Bank of England Inflation Attitudes Survey. It's done quarterly by Ipsos, big polling house, more revealing than half the other official data that you'll see out there. It doesn't tell you what's happening to prices. It tells you what real people believe is happening to their money. And I know that normally I would say, don't worry about expectations, we need to look at actions, but actions really do depend on expectations here, because this is the number that people take into their annual pay reviews thinking about. This is the number that makes them think about whether they're going to buy something today or buy something further down the line. This is the number that makes them think, shall I borrow to buy that thing today, or shall I wait till further down the line? So this is really, really important stuff, folks, because in the inflation game, belief is at least half of the battle. Perception is reality, the marketeers say, don't they? And it's not far off here, right? So, survey data from late April to early May, fairly up to date, and goodness me, the public really has started to notice. So the median estimate of current inflation, 5%. That was 4.6 in Feb, which obviously was pre-war, apart from anything else, so do bear that in mind. But the year ahead expectations jumped to 4% from 3.2. So it seems they were listening. Now, I was citing that 3.2 figure, saying people are generally pretty savvy in these situations. They're better than the economists and the modelers are at talking about what inflation is going to be, which is why I was at about 3%. Not because I copied the number from that survey, but if I'd been in that survey, I would have said 3% in a year's time back in February, because I believe we live in a 3% inflation world at this point in time. And obviously that was pre-war. At this point, I would be at 4 or 4 point something in a year's time is where I believe we'll actually be. But if the war's all been ironed out, then the Bank of England could go, well, looking back at what's happened to the data, blah, 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 transitory. And this time it could be transitory because it could be much more compartmentalised than the pandemic and not trigger a spiral. But ultimately, people are going to be out there asking for money, being unhappy, trying to get more from their employers. Their employers will then be pushed into, what does this mean for the minimum wage? And therefore, what does it mean for hospitality and this and that and the other? It's going to get even more expensive to go to the pub, go to the restaurant, go bowling, do whatever else you want to do, folks. It's just the way that it's going to be. Goodness knows how many years that's going to take before someone tries to break that scenario. But I can't imagine. So, in the medium term, we're looking at pay rises based on inflation expectations, right? It's very, very important stuff. The 5-year expectation is at 3.9% in 5 years' time. Now, I'm not going to put too much weight on that one, because how can you work out what inflation is going to be in 5 years' time? It's very, very difficult to perceive. But seeing that at double the inflation target is really worrying. And possibly also because the bank obviously has not made many noises about actually putting rates up, and hasn't looked like it's going to put rates up, and doesn't look like it will put rates up at the MPC meeting this week. So, what will worry and what will land at the Bank of England Monetary Policy Committee? 53% expect interest rates to rise over the next 12 months. That was 30% in February. So interestingly, even in February, 30% of people were thinking interest rates might rise. Now, you could say, well, they were just poorly informed. Everyone could see they were going to drop. Well, they couldn't, could they? Because they haven't dropped and they aren't going to drop. But neither was 30% of the people suggesting there's definitely going to be a war in Iran and therefore that's going to be inflationary. I think that would have been a small percentage of people. There were geopolitical predictors who did this. But of course, in the world we live in, when you've got 4 billion content creators or whatever, then there's always going to be someone who's predicted something's going to happen. And then after the event, you can track back and say it. And I actually see people regularly, some really quite preeminent people these days, embarrassing themselves by constantly predicting these terrible things, knowing full well that if the terrible thing doesn't happen, it'll be back in their YouTube catalogue 200 videos ago. But if it does happen, they could reshare that video 100 times. And it's dry again, Charlie Munger. Show me the incentive, I'll show you the outcome, right? Their incentive is to go viral and make money out of this stuff and raise their profile, not to try and share true and accurate content for people, which I will absolutely always make sure is my number one and only driver while I do this stuff. As I look right now, there's actually 5 people listening live, so 5 is a great number. Thank you for giving me that time. Some of them probably got me on mute or whatever, or in the car or something like that. But I'm obviously not going to be moving any markets with 5 people listening to the live. But there we go, right? I press on regardless anyway, because that's my personality type. How many people are expecting cuts? So in February, only 29% of people were expecting cuts. That's down to 11%. Those 11% are off their canister, may I say, folks. There could still be cuts that would require a collapse in something over the next 12 months for that to be the case. And I wouldn't be talking about a 0.25% cut, right? 49% say rates on mortgages, loans and savings have already risen over the past year. That's up from 32%. So they've seen that, haven't they? What was the loose path of all this stuff since 2023? We saw from the beginning of 2023 a bit of a drop as the market steadied because of Sunak. Then a big rise in the middle of 2023. 5-year gilts went above what they were when Liz Truss was in charge, as we coped with the new world and the massive inflation that we were grappling with at the time. Since the middle of 2023, fairly steady path downwards. Few wobbles, few bits and bobs, Liberation Day, this, that and the other. Labour government have come in, yawn, but ultimately steady up until February this year. Ultimately, those rates have come up on instant access savings and things like that from 49%. So 49% think that's happened to them. 32% have been saying that before, and that 32%, I'm not sure how closely they were watching, because over the year, from February 25 to February 26, they haven't moved a lot at all. But of course, you don't look at this stuff every day, so maybe it's a fair number. So, wider mood darkened by 78% to 4%. Respondents reckon the economy ends up weaker, that's the 78, versus stronger if prices rise faster. The 4% must have some nice inflation-linked assets. They're probably property investors and things like that. But that's 78% think inflation is damaging. The number in the February survey was 72. Why does that change? Well, look, it's a little bit of noise to an extent, but they're getting the messaging saying inflation's coming, inflation's coming, inflation's coming, inflation's coming, there's a war, blah, blah, blah. So it's making it hit home harder, right? I've got to talk about the weight of the cake here, folks. So I'm a big fan of the weight of the cake argument, right? And this is a tried and tested piece of research, right? Ask 100 people that are faked or similar to guess the weight of the cake, and you'll get some idiots in there who've put some crazy numbers in there. I haven't got a clue how to weigh stuff, right? But if you take the median and the mean out of those 100 guesses, they're incredibly accurate as a general rule, right? So if you want to try and win one of those, make sure you go last, and then make sure mentally you can either take a picture and whap it into GPT or whatever, get it to do the maths for you, or you've just got to be an incredibly acute mathematician. That's how I've had to try and do it in the past when I'm trying to win the same sorts of competitions. And yes, that is the sort of thing I love to do in my spare time. Just because I like winning stuff, not because I'm worried about guessing weights of cakes, obviously. Everyone else is doing the heavy lifting by working it out themselves, right? But this is the same logic in this sort of survey. On the bright side, only 53% thought there would be a rate rise, because it is a genuinely really quite close call, and they may be able to hold off. The central bankers would rather do nothing. Well, we all would, wouldn't we, if we were getting paid 200 grand, let's face it, and have a world-class pension behind us. But no, it is also better for everybody if they do nothing, unless something really, really needs to be done, right? So why does it matter so much? Because this is a self-fulfilling prophecy thing, right? The entire reason the bank runs this survey rather than just eyeballing the CPI is if everyone just believes prices and rates are going to head upwards, they will push harder for pay rises, and that's the bit that worries the Bank of England, because there is that wage price spiral 1970s hangover that they worry about. They will bring forward purchases, and businesses will pass through cost rises faster because the belief greases the outcome. You don't wait if you're in business, you get on with it and you raise the prices sooner rather than later, right? That then is something that creates inflation. People see it and go, oh, I need to ask for more pay rises, right? So the bank fought a long grinding battle, 2022 to 24, to try and keep those inflation expectations anchored. Probably not helped by people like me who are going, why are they saying it's transitory? The idiots, it's obviously not transitory. Inflation's embedded within the system. And of course, that has turned out to be true. I was completely correct with all of that, right? But it's still important if you're the bank to try and make sure people believe it's not endemic in the system. And now, apart from anything else, you have a reason, or should I say an excuse, probably the latter, as to why none of this was our fault, Governor, because it was the war that did it. People are going to forget, because they will, because people aren't obsessed with this stuff like I am. They're going to forget that inflation was already at 3% before the war came along. Right? It's all going to get blamed on the war from here on in over this next cycle of the Overton window as far as inflation and interest rates get talked about. Whoever's in charge of the Labour Party or the government, that's all that's going to happen, right? I'd rather focus on solving the problems myself, but that's where we are. But if you lose the anchors, if you lose the inflation expectation anchor down at the target, that's when your bond yields suffer because your bond investors are worrying about anything else. The analogy here really is the anchor is dragging along the seabed, but it hasn't sort of anchored itself into the seabed particularly. The bank will be more rattled by this survey than they will be by the GDP print being minus 0.1, believe you me. Because that minus 0.1 might get revised away next month. And the bank don't worry about 1 month's details, realistically. And we shouldn't. You can't make a decision based on a 1 month growth report, especially if something happened to fall in February rather than March, or March rather than April. It changed the way that month was measured. And those, as I say, Feb and March were... Feb and March had performed much better than anybody thought they would. April then underperformed compared to where the PMIs were, probably, it's fair to say. But this has been many weeks and months in the making, this point, realistically. You know, businesses were holding the line. There won't be any pay rises linked to Iran. We're all in it together, right? That's not going to happen because this is now visible in this survey. So businesses saying that are not going to help to anchor inflation expectations. People work on the basis of what they see, right? So now onto the Gilts and the Monetary Policy Committee meeting that's coming up this week, right? And one of my favourite, allow me to geek out if you will. If you're watching on replay and you skip this section, let me know you did because you thought it was going to be really boring. I'm hoping it's going to be really good, right? We know that the base rate is 3.75. We know it's been there for 6 months now, with the final cut of what will now be that easing cycle was in December. The next move is probably upwards, but it's probably not this week. Let's just get the main points out of the way before anybody skips this part if they're watching on replay. But the 10-year gilt up about to 4.94 in the middle of the week. It's highest since late May. There were points where people like Peston were saying it's over 5%. It never was that I saw, Robert. I don't know where you get your numbers from. You need to work harder to make sure you're painstakingly accurate. I think it was about 4.97 at one point intraday, but I don't think it went above 5%. But anyway, what do we do here? We watch the 5-year money rather than the 10-year, don't we? Because we worry about our 5-year fixed rate mortgages. You don't see many people trading in 10-year fixed rate mortgages. Closed the week at 4.375% yield, opened at 4.508. So normally we get the bunting out, 13 bips, it's dropped. Hooray, fantastic. All that work was done overnight between Thursday and Friday after the Truth Social posting about us being closer to the end of this war than we have been, and that confirmation from the Prime Minister of Pakistan that was the case. But look, we'll take that as a direction of travel, folks, because that's what we need. Then there was a sell-off mid-morning, so the bonds sold off. That means the yields go back up because people remembered, actually, hold on a second, this is buy the rumour, sell the fact. What should we do? It was a volatile day in the bond markets, but it ended up clipping back downwards again. Not quite as far down as many people thought it was worth. A friend of mine texted me and said, what do you think this is worth in the bond markets when it is all sorted? I said probably 25 to 50 bips. That's my range for how much it will clip off from here. So we've got a permanent hangover of this war, or certainly a temporary permanent hangover of a year or so. That will then start, it will ebb away over that year. But if there was more of an adjustment in this market than 25 to 50 bips, if a proper deal was signed and the ceasefire's all good and the ships are flowing through Hormuz, I'd be quite surprised. But 0.5% drop in the gilts, right, is still significant, still 2.5% over 5 years. So you shouldn't underestimate how significant that is. And it'll be really big this week when we see what the Bank of England chat is like, because if I'm right and they're going to hold, and we'll get into the correct score in a moment, but if I'm correct and they are going to hold, then ultimately they're still going to give it some fairly hawkish chat, believe you me, about let's see what happens in Iran. That much you can guarantee, right? And the markets are still not going to be particularly calmed by all of that. They're still not going to be happy. I don't know if bond investors are ever happy. I don't think it's an emotion they worry about too much. They're fairly robotic about what they do. Anyway, what about the 30 years? Well, less volatile, still came back about 10 basis points on the week. 5.63% yield on the open, 5.53 on the close. Still look like incredible yields for 3 decades, in my humble opinion, but there we go. And then the swaps were lower on Friday, but we didn't see yet the dramatic shift of the gilts. So the last trade at 4.1 on the 5-year, but that's 6% to 6.1% limited company financing I keep talking about. 5-year mortgage, no arrangement fee, that is still accurate, I'm afraid, folks. That's the cost of the money at the minute. About 40 basis points adrift of where we were 1 year ago, which is a significant reason why property figures look poor right now year on year. This time last year, things were ebbing downwards nicely. Everybody thought the rates were going to drop. That gave confidence to first-time buyers and people like that. Affordability was good, and it had been improved by the changes that had been made by, well, they weren't made by the FCA. It was the way Rachel Reeves pointed out how the rules that were written actually worked, which then caused up to roughly about £28,000 more being available to the same income borrowers in about March 2025. That was first kicked in. So we're 12 months on from where that's sort of kicked into the market now. But 12 months ago, rates were going downwards nicely. Very recently, with this very recent wobble in the market, people have been seeing that rates have been going upwards and just being priced out as well, apart from anything else. So it's affected confidence and it's affected affordability from a mathematical perspective as well. So look, this is a turn. It's not some kind of screeching handbrake. It's not some kind of crazy, we've all got to lose our minds and do 73,000 thumbnails about this and that and try and mug our audience off and all the rest of it. It's just not how I operate, as you know, right? At the turn of the year, the market's best guess was a base rate heading down towards 3.25 by the end of 2026. The only argument really was about how fast, and that's gone. It's completely gone. So let's just reiterate that right now. Not the first time I've said it over recent months, but worth repeating, right? The last meeting was the 30th of April. The vote was 8-1 to hold. The one dissenter was the chief economist of the bank, Hugh Pill, not a non-exec, not someone who's arm's length from the bank, not someone who does anything else day to day. The Bank of England's chief economist, right? He didn't want a cut, he wanted a hike. He wanted to go to 4%, and it was the first vote for higher rates since the tightening cycle ended in 2023. So first vote for higher rates for nearly 3 years. Folks, just bear that in mind, right? Very little fanfare around all of that. A committee member broke ranks in the hawkish direction for the first time in years. Money markets followed, our pricing tightening rather than easing over the next 12 months. The debate centering on whether a move comes as soon as autumn and whether 4+ is really on the table by the end of this year. So what's the clearest single expression? The bank's own 1 year ahead bank rate expectation has crept above where the bank rate sits today. The curve is pricing in a base rate higher in a year's time than it is right now. That's what the market thinks will happen, and that's what the bank then reads into and uses in its models, to be clear, right? From how many cuts to is the next move actually going to be upwards in roughly 6 months, but it's all the war and the oil price doing that heavy lifting. And we have seen this movie before, folks. Cost push inflation, commodity prices, energy, shipping, same mechanism as 2022, same lazy argument. There's no point putting the interest rate up because it doesn't fix cost push inflation. Nobody ever said that it would, right? You don't pump any extra barrels of oil through Hormuz by raising the bank base rate, right? But it's never been the point. It wasn't the point in 22. It's not the point today. It's about expectations, and it's about pass-through, second-order effects, derivative products of oil, and other things that are involved here, like fertilizer and food prices, right? That is all seriously important stuff, and that is inflationary, folks. And expectations are inflationary, and if you don't put rates up in these situations, then people expect more inflation, because the thing that they do know, basically, what do people know about basic economics? Supply and demand. They think they know about it. They argue with me on the internet all the time, and they also argue, or they also know something about the fact that inflation and interest rates move in the same direction as a general rule, right? So if there's more inflation, there needs to be more interest rates until the direction of travel changes. Inflation comes down, then rates can start coming down. Those are the basics of economics that most people know. Certainly the people who are savvy enough to be feeding into Bank of England expectation surveys and things like that, right? What you can't do is shrug at these things. What you can't do is what Donald Trump did the other day. It was a good job he's not involved in the central bank side of things, although obviously his man is now implemented in charge and say, oh, I love a bit of inflation. It's like, mate, you owe $37 trillion. You can't love inflation. Your bond investors hate inflation. You've got to do your job and control it. Although what he did there really is he let slip what he really does think. He does love a bit of inflation, right? Sorts him out, although his net worth is going up, not just thanks to inflation these days, isn't it, Mr. Donald? But the bank doesn't want to put the rates up, and no, it will hurt the economy. The economy is not strong at the moment. 1.2% over the year is stronger than a lot of people thought it would be, especially still reeling from Rachel Reeves' national insurance rise on employers in 2024, right? That's a 2-year project in terms of extra impact on things and people. And it'll certainly, I carry it in my businesses today, and I'll carry it for all time in terms of the difference it will make in terms of how many people I will employ going forward. That is the reality of it. Cost goes up, can't afford as much of it. Welcome to economics, the allocation of scarce resources. Don't really need to point that out, I don't think, to my audience, but there we are. Little ranty. So I've done it now, haven't I? But you don't want to hurt an economy that's already somewhere near the toilet with construction contracting. You know, Andrew Bailey has been at pains to say there's no rush for all this stuff, right? But no rush is not never, right? It's just not next meeting. But let's see, because we've got to look forward to, you know, another inflation report, another monetary policy report. And when the facts change, guess what? I change my mind, apart from anything else, right? So let's see what happens in September, October. 8-1, one hawk breaking ranks. That's where we were, but we know where the risks are ultimately. So member by member, here we go. Hugh Pill, he was the dissenter. He's voting upwards, folks, isn't he? He's going to be another vote upwards. There's no reason for him to move that attitude from last time. Megan Green, my personal favourite member of the Monetary Policy Committee, in terms of we tend to align in what we think about things. That's either a great sign or a terrible sign. But obviously, Ms. Green is far better qualified than I to be on the Monetary Policy Committee. But she openly has already floated that we might need a hike if Iran drags on. It has dragged on since she said that. So single likeliest person to vote upwards, a probable upwards for me, right? Next up, you've got the Deputy Governor, Claire Lombardelli, put into place by Jeremy Hunt. And then you've got Catherine Mann, the non-exec, American economist. Difficult one to predict. I find Catherine Mann the hardest one of all of them to predict. A probable hold from both of them, but one of them might defect. So if we have a 6-3, it's one of those two that's stepped out of the hold pattern and into the hike pattern, into the hawky camp, right? Bailey, well, no rush, says a hold, doesn't it? I mean, he's already told you what he's going to do realistically. I question him as a follower rather than a leader, but he is the least talented economist by a long, long way at the Bank of England Monetary Policy Committee. So perhaps he should be a follower. Perhaps that's just good chairmanship. Perhaps Andrew Bailey or anyone else listening to this would tell me that. What about the Doves? Well, we know who they are. Dingra, Taylor, Ramsden, Breeden. They've all leaned looser during this cycle, right? But none of them are voting for a cut this time round. But I'd be surprised if they did anything other than hold. In fact, I'd be really, really surprised if they did anything else. So I'm going to go with 7-2, which disappoints me because that's the economic consensus as well. I didn't look at the consensus before I did my build of the vote. By the way, I did that first. Then I looked at the consensus. But 6-3 wouldn't surprise me an awful lot. So I'm probably 60-40, 7-2, 6-3. Anything outside of that, I should really leave 10% either side for unusual outcomes, generally speaking. But that's where I am right now, today. On Sunday, it's not necessarily where I am on Thursday, because who knows what will have happened in the Iran situation between Sunday and Thursday. And it could genuinely go either way at this point in the time. But the story is they're split as they've been split before, and it'll be a more significant split than it's been in the past, which means it's close, which means the rate rise is close. We get tells from the Bank of England just from the results. Even if you didn't read any of the headlines, any of the speeches, any of the stuff the MPC committee say, you would see this as a potential tell, right? This is a potential tell that the next move is a hike. That's where we're going to be. So if the facts change, I will change my mind, folks. Keep an eye on my socials. If I do change my mind, I will let you know, especially via my LinkedIn, right? But it doesn't really matter. We're all taking it anyway. We are not rate setters at the Bank of England, let's face it, right? Now, what matters most? Well, mortgage pricing follows swaps, remember, not the base rate directly. Swaps have already drifted upwards in general anticipation. Fixed rate pricing has been edging higher. Quietly, not so quietly, realistically. What will happen at high noon on Thursday? Let's see. The market has effectively already tightened on the bank's behalf anyway, right? If we've got 3 hawks, that's probably going to speak more to your 2027 remortgages than them moving 25 bips this Thursday. Watch the dissenters, not the headline. I could be wrong on the precise timing of the first move. I think we're looking at about September at this stage for that first move. I don't think I'm going to be wrong about the direction, folks, I'm afraid to say, because regardless of the war ending, the damage is done, right? For your LTVs, your stress tests, your fixed versus tracker calls, that's the thing to build around, not the exact date. Someone asked me this morning on a supplement post what I recommended for their 5-year fixes or for their mortgages that are coming up. I never recommend, right? I'm happy to say what I've been doing. What I do is I use 5-year fixes as a general rule, almost across the board. If there was a crash in interest rates, and that could be a problematic situation rather than a good one before anybody gets excited, I would then just look at paying the early repayment charges, because I'm buying insurance with fixed rate mortgages, folks. The insurance is I'm in control. We don't have another energy spike. We don't have something else happen. China go into Taiwan a bit earlier than they were planning to. Seems unlikely that to me at the moment, but you know, in this world, who knows, right? Iran actually reveal they've done all the uranium enrichment that they need to, and they're very, very close to a nuclear weapon, and then things change again. Who knows, folks? Who knows, right? So we need some optimism with this realism, right? There's context from recent weeks here, and I've been saying it for months. I still believe we're around 25% capital growth nominal pricing over the next 5 years. The amount of inflation that's come out of this Iran situation more than makes up for the change in the interest rates and the change in the capital values based on that is not happening based on these higher rates of interest at the moment, right? Now, of course, a lot will depend on what's going on in the Middle East. We'll still be dependent on oil in 5 years' time. Let's face it, we know it. It just seems like the 25% is back-end loaded, right? There's still a big bull run coming, folks. House prices are cheaper than they have been for 23.5 years. That trend will not continue. Houses are not cheap in anybody's by anybody's reckoning, apart from the real inflation-adjusted figures. There's also still room for more easing of lending requirements from the FCA and the PRA, right? And then 30-year value bonds, look, they still look amazing compared for no effort. It's pretty incredible what you can do. You are placing your bet on inflation not being out of control, but if you've got a 2.5% premium above probable inflation for the next 5 to 10 years, and then a potential deflationary economy after that, and of course, if you believe the Kevin Warsh argument, and I do have some sympathy with it, the AI disinflation that's going to kick in. Tech has disinflated prices. It's actually deflated a lot of tech in price terms over the 50 years it's been part of the household, and of course the last 20 years and the smartphone and everything else, much more concentrated tech deflation, actively deflating, right? If I had significant liquidity and I wanted very little effort, I would be smashing into the 30-year bonds. If I could sell my portfolio at 120% of its value tomorrow, all that money would be going into gilts, and then I'd be reinvesting it. I'd be rebuying properties, to be honest with you, because I couldn't help myself. But all that expertise and all the contacts and the fact that I can buy them at significant discounts and things like that, it would be difficult to walk away from. But here endeth the lesson on current rates, and here comes the deep dive. We're only 1 hour 52 minutes in, folks, and we finally got to the deep dive. So the thread here is going to connect through all of these 4 reports, because they all landed in the same few days, and for completely different angles, they circle the same question, right? The quote from the beginning of the supplement today about land and inequality of land, apart from anything else. Not something you hear Gary talk about. So, the affordability wall, right? This is one story divided into 4. Why can't people afford to own a home? And why won't simply building more just fix it, as the slogans promise, right? We've got a select committee report that frames the whole paradox, and my take on that, as always. We've got what the Bank of England's own agents are reporting on out there at the coalface, the businesses that talk to the Bank of England. The West Midlands regional rep is unlucky enough to talk to me on a semi-regular basis. Luckily for him, he also talks to hundreds of other businesses as well. And then that's the intelligence that the Monetary Policy Committee has in front of it. We've got a charity number that's so large, it's almost hard to process and take seriously. But the 119 years to clear the existing social housing waiting list at the current rate of build, this is not a joke. And then the think tank proposal to raid your future pension to get you on the ladder. it's not the worst idea in the world in terms of the general locus of where they're going, but I think I've come up with a better solution than what they've fired up, quite frankly. So you'll get to watch all four. Remember that Henry George quote from the beginning. So keep close to the land question and then reach for a deposit subsidy instead. I'm not sure I'm keen on that conclusion, but let's see what happens. So this is a fresh lens. It's not a repeat. Last week it was claims of supernormal profit, Manchester social housing, Savills built to rent viability and flood risk. And then the week before that, it was the Resolution Foundation, it was House Builders Federation, it was Business London. We're moving from the rental market's plumbing to the ownership affordability wall. Same thesis, but fresh evidence, right? So first up, Housing Committees and Local Government Committee report on the affordability of home ownership, right? So best framing of the problem that I've seen for a long, long time, actually. And there are three themes. First of all, the affordability collapse in the numbers. So home ownership, 2003, 71% peak. 2021 census, 62.5%. Now, the 2022, 3, 4 English housing surveys, 24-25 English housing surveys, have got a number more like 66% than that 62.5. But of course, the thing about the census is they do ask everyone. So it does make me wonder, and I've never seen this question before because I wasn't aware of that 62.5% number before I did the work for this week. Are we talking about the fact that when you have the English housing survey, the people who don't own are much less likely to answer the survey? It does seem like that's potentially possible. So do we have to trust the census numbers? The trouble is, if 2021 numbers are very, very stale, especially because of the scale of the change of what's happened since 2021. So we do have to bear that in mind. And 2021 numbers were collected during a pandemic. So are they right? Who knows? I think we need to be cautious. So we'll stick with the English Housing Survey as a general rule, because that generally is what attracts the attention of the parliamentarians, apart from anything else. Sharpest falls amongst the young, though. Institute for Fiscal Studies found just 25% of 27-year-olds owned in 2018, down from 43% a decade earlier, pre the repossessions after the financial crisis, we should say there. So that is obviously a controlling factor that we need to be aware of. But that's a big, big move. I don't know why we're picking on 27-year-olds, and I'm not happy about specifically picking. It sounds like it made more difference in 27-year-olds, and that's why we're picking 27-year-olds. I find that strange, but there we go. But we'll get into that anyway, because this is the reportage section ultimately. And in 1997, the median home was 3.4 times median earnings. 2024, that ratio was 7.71. I have a few thoughts on that need to be controlled, but ultimately that is more than double. So that does need to be considered. 1997, again, you're cherry picking a time where you'd had a massive adjustment in prices between 1989 and 1994. Inflation kicked the absolute you-know-what out of them, and they did go downwards. And then you had a very, very flat market in London, literally until about 1997, when it absolutely took off like a rocket. So when we're making a temporal comparison there, we're picking, ultimately, about really cherry picking about the lowest year in probably 40 in a cycle to start measuring from. And I just hate statistics like that. They're just rubbish. But that's what the report says. So it's obviously trying to make a point. It should be reportage. It ultimately doesn't look like it when you start cherry picking data like that. But the average home at the end of 2025 cost £273,077, more than double its inflation adjusted level of 50 years earlier in 1975. Now, Bank of Mum and Dad, 38.5 billion drawn down from the Bank of Mum and Dad over the past 4 years, according to the Home Builders Federation, and that's 71% more than it was the 4 years previous to that. Now, I'm much more happy with the Home Builders Federation numbers because I think they've got less agenda to them apart from anything else. And around 52% of first-time buyers now get family help, averaging over £55,000. So it's not small, right? But look, we need to demolish this 7.71 times median earnings, right? Flaw number one, we're using this compared to a single. Why are we talking about a single earner? Single earners are, generally speaking, not buying properties anymore as a household because you have two earners, right? You have two earners due to all sorts of things, right? In 1975, it would have been the mode would have been a single earner per household. Now it's very much two earners per household. It went out with the arc, that whole thing. Now, generally, this is because of the liberalisation or liberation or emancipation of the female household member. That's the reality of it. That should be a cause for celebration. Why are we not counting her earnings in the multiple, right? Now, then I've got to have a go at the 27-year-old ownership figure. Why have we picked the 27-year-old, right? If 50% are going to university rather than 25%, and that's roughly where the numbers land, not over the course of that decade, but over the course of 1997 to today, that is, but still, there's big movement upwards in the number of people who've gone to university. Why are we still gauging people by where they are when they're 27? Right? You're spending 3, 4, 5, 6 maybe years out of the workforce. So an extra large swathe of that population are in a vastly different position than they were, but they've put investment into themselves so that they can ultimately earn more money later in their careers. So we shouldn't be comparing today's 27-year-old to a 27-year-old even 10 years ago, realistically, and certainly not 30 years ago. It just becomes a nonsense, or at least you have to adjust the data and compare it accordingly. And then flaw number 3, well, look, what about the interest rate, folks? If you had a 7.71 times multiple on a 2% mortgage, if you were lucky enough during a lot of, and this is, I believe, when we get another 30 years down the track, we'll look back and say how lucky the millennials were. Why were they so lucky? Because they were able to pay very low interest rates on their properties. Now it's much harder for people because they've got to pay a normalised interest rate at the house prices that are higher, but as I say, adjusted for inflation, are drastically lower than they were in 2022, apart from anything else. But the amount you've got to pay out every month, which is capital and interest, right? Remember that, is going to make a massive difference, isn't it? To how many houses you can buy, how quickly you can buy them, and all the rest of that. As a population, I mean, rather than an individual there. Do you want to compare a 2% mortgage to a 5.5% mortgage? It's just not realistic, is it? Wildly different bank payments, yeah? And this is the bit that's moved in the last 18 months because prices have barely budged, but the rate has roughly doubled, certainly since 2022. So we're going back, it's probably over the last 3.5 years that the interest rate has basically doubled. In terms of the actual pay rate I'm talking about on mortgages. So real affordability deteriorated far, far harder than that. But this is the metric the politicians wave about, this median, and it hides the variable doing the most damage, right? But this is as much the fault of The Guardian as it is anybody else, realistically, in this debate. Just don't explain the mathematics to the people who don't ask questions like this, which is a real shame, right? So these are all corrections. These are not me saying houses haven't gone up in value. I'm not denying the fact that they have gone up in value significantly since the 1970s. These are all controlling factors rather than making it a foaming at the mouth thing that then leads into the fact that what we really need to do is cap the rents and seize the assets of the people. Really, that's the way that Mr. Polanski would like to sort it out. Let's just get that out into the open, folks. That's how he rolls, right? So, what this committee did get right, and most of the politicians don't talk about, is inherited wealth, because, of course, people are aspirational in this department, and if you have children, you will know that you want to look after them. Now, there are questionable ways in which are you looking after them by helping them out and giving them money. That's a very, very different conversation, which I'm very happy to have another day, probably better on a podcast with somebody else. But ultimately, home ownership stops being about your job and starts being about your parents' house. That is a problem. Right? What property even is as an asset has changed since buy-to-let has come out, apart from anything else, right? 38.5 billion ploughed in for the Bank of Mum and Dad over 4 years, up 71%. Feels a bit like more than a top-up, doesn't it? That's big, big money. It's a structural pillar of the housing market, and it's being held up by parental equity, bolting into yesterday's inequality, bolting into tomorrow. Some of that will have come from right to buy houses that people have stayed in, especially if they were in London. Right to buy flats and things like that they paid 32 grand for and are worth £1 million, even in today's London market, right? That then, what was unequal for them, the ladder's been pulled up and all that sort of stuff, right? It's got to be borne in mind. Problems with right to buy policy, again, another one for another day, probably, right? But again, this evidence is all gathered pre-war, so the recent rise in mortgage costs, it actually flatters the current reality and the ladder's come up even further since they closed this inquiry. But being born in the UK is still, you should bear in mind, a lottery win on the planet, realistically. Okay, it's 5 numbers in the bonus ball. It's not the full win, okay? But it's still a big win. Okay, what about the supply paradox, right? This is the bit that everyone should listen to twice because it cuts through the political noise from both directions. So the Greater London Authority has done some research. Building at any price point improves affordability through chains of vacancies. Not something that people like to admit, but even building the expensive stuff helps out. Dare I say trickle down? I know what trouble you get into if you mention trickle down economics. Not that anyone serious talks about trickle down economics really working, but that's what the research of the Greater London Authority have shown. It will empty units further down the chain for the privileged who can afford to move into the penthouses and therefore make them available, that they will then sell, because that's how the incentives generally tend to work. So raising the housing stock by 0.5% would cut average prices by about 0.8% by 2029. Now, against that, the Resolution Foundation argued perhaps 10 years of sustained high building before material affordability impact shows up. The IFS's Peter Level says even if you build loads of houses, they're still going to be very expensive. Yep, absolutely. The Housing Minister conceded the best realistic outcome is a sustained levelling off of house price growth, not falls. Now, I'd argue that's actually better. Right? What you would rather is house prices going up 1% a year if you were the government, and inflation going up probably 3% to inflate away your debt, maybe 3.5% because that's about the most you can get away with. Then they're getting 2.5% cheaper in real terms. The maths is not exact there before anybody starts on the YouTube comments about how many PhDs they've got and analysis of variance and all the rest of it that they like to do. But ultimately, that's where you end up with houses becoming more affordable in real terms. And I am not quoting Q1 2003 as the current real terms value that's equivalent to the Q1 2026 number that we saw at the end of March 2026 as the bottom of the real market. Yeah, but if we have 25% cap growth over the next 5 years and it's back end loaded and inflation ends up being about 20%, right? That is not an impossible scenario, folks, but it probably gets cheaper before it gets more expensive. So just bear that in mind. We could be a year and a half away from the bottom of the market, somewhat sponsored by what's gone on in the Middle East in 2026. So what about the OBR number, right? This 0.5% increase in the stock, that's massive, by the way. 150,000 homes, apart from anything else, yeah? On top of everything that you have already, so an extra 150,000 homes, moving average prices by 0.8 by 2029. Not 8%, by 0.8%. That's the supply lever by the government's own forecaster. Basically a butter knife brought to a fight when you could do with a chainsaw. Let's face it, right? So what about the demand side? Well, if buyers have got a deposit and prices will respond fast and fully, help to buy. You add firepower to a fixed target. That asymmetry is the whole paradox in one line. Demand side help works almost instantly and in the wrong direction, prices go upwards. Supply side building works at a crawl over a decade for a rounding error on the price of housing. I'm not arguing against building. It absolutely needs to be done. It's the argument against expecting that building more would fix affordability. It's either a known lie or it's an unknown lie, right? But ultimately, it's one or the other. The real maths, yeah, even if you do the 300,000 homes a year, you add 1% to the housing stock in the UK, right? And that's a net 300,000, not the ones you knock down, not blah, 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 or the ones that should have been knocked down years ago, but we stopped knocking them down in about 1980 because it started to help the figures because we weren't spending the money building the council houses anymore, but we were busy selling them off as it went, as wrecked the market realistically from there on in, but helped that generation massively with social mobility. So a double-edged sword helped the whole right to buy argument, right? The honest position is the minister's own position. Prices flatlining in nominal terms, wages slowly catching up, which ultimately is what's been happening since the era of the lettuce. I'm not sure we can call it an era, I know, because eras tend to be longer than the amount of time that Mary Elizabeth Truss was in charge, of number 10 Downing Street, 4. But nominal flat, real terms decline, affordability improving by stealth through inflation rather than falling prices. Not a crisis to any patient investor in any type of stock. Slow, quiet repricing that has been going on for years now, that I've been talking about, that's now going to be extended thanks to what's happened in the Middle East. Now, Had a few DMs about a crash. People saying, I smell this is just like 2008. I'm ready for all of this. My starting position on the reply to these folks, please don't send me anymore, is a crash from where? Right? Crashes come in overheated markets. And this is a living room with a heat pump that is not doing much because the house is so leaky on insulation. Right? The danger is only ever leverage at the wrong loan to value when the music changes. And with rates flipping to hikes, that danger did just go up a notch. So do bear that in mind. I've had a comment actually on the Property and Poppadoms. Thank you, John Cox. Hello, John. I didn't see you were there. Saying Help to Buy surely has to come back. Well, look, I thought it was coming back last year. I remember saying before the budget had a few tip-offs it was coming back, and I thought it makes sense because they want to drive things along. Let's see what happens. It's possible, but I think if they really want to drive prices, they've got to cut stamp duty. But let's see if that happens as well. It's probably a desperation play to try and stay in power rather than doing anything else. But of course, it's only taken 2 years for Keir Starmer to turn everybody against the Labour Party. Perhaps Andy Burnham can turn them back around in less than 2 years. Who knows? Who knows? We'll find out, won't we? What we know is he probably can't do a worse job, realistically. So, stamp duty. Onto the stamp duty. Nice segue there. The tax that nobody will touch, right? A known bugbear. So the committee called on government to move faster and bolder. That's like further and faster. That one will go out with the arc as well when Starmer's done on stamp duty reform, saying it continues to slow the whole housing market and damage the economy. Also, it called on them to replace the lifetime ISA with a home buying product free of the punitive withdrawal charge and outdated regional cap. Certainly, I believe you can still withdraw without the charge if you're using it to buy a house, but the regional cap does need to go, right? Ease some of the mortgage finance restrictions and bring empty and underoccupied homes into use, the lowest hanging fruit of it all when it comes to supply, and help small and medium-sized enterprises access development finance. What a wonderful list of things to think about. Stamp duty does go up the entire chain. It punishes the downsizers who would free up family homes, punishes the mobility the labour market needs, and at the second home and investor end is a material drag, which you can see increases numbers all year. Been loads of stuff in the industry press this week about the 8% stamp duty in Scotland, and Scotland struggling with the number of rental units because who can buy them at that state? And as people organically waste, as they like to say in the economics industry, or aka they pass away, they retire, they extract the equity from the properties that they've owned, who's replacing them when LBTT, as it is, or ADS, as they call it, the additional dwelling supplement, is actually 8%. Yes, EIGHC. Not the 0.8 that the ONS, that the OBR, that other people have been talking about, but 8% additional dwelling supplement on any units over 40k. How many have I bought in Scotland since it became 8%? Zero. Not because I don't want to buy in Scotland, but the figures just don't stack up on the vast majority of the deals, thanks to the 8%. What's underappreciated about stamp duty in general? Well, the tax does not just cost the Treasury the transactions it kills outright, yeah? It also costs the economy all the activity that would have followed each move. Removal firms, carpet fitters, kitchen fitters, white goods, solicitors, brokers. A house move is one of the most economically generative things that a household ever does, and stamp duty sits at the top of the chain, suppressing the lot. The downsizer who stays put is not just one frozen transaction, it's a family-sized home kept from a family that needs it. Then why damage the economy is precise, not hyperbole. This is something I'm going to try and do some deep research on, folks. I'm going to set this to play. If you haven't seen it before, I do have a second newsletter on LinkedIn. It is called the Propenomix AIX newsletter, very deliberately because I use AI to do the vast majority of the heavy lifting in all of that. And I publish the results for everybody's viewing pleasure. So there's some fab stuff on there. There is another YouTube, which again is AI video generated stuff. That channel is called Propenomix AIX, and any new subscribers would be vastly appreciated. It does generally do relatively evergreen sort of stuff, so you don't have to rush to it every week. It's not quite like the supplement, keeping you up to speed with everything and letting you know what to do in real time. You can go back and look at some of that stuff, but I have examined nearly every property strategy, as they like to call it in the industry, known to man, woman or beast, and a few more that I didn't even know existed. So there's some good evergreen stuff on there, and I still try and add about a video a week to all of that content. Right. Thanks for that opportunity for a little plug. Anyway, so is it going to happen? Well, it's about 15 billion stamp duty brings in. So it's a big line of revenue. for anybody staring at a fiscal hole. Cut a property tax so landlords can buy more properties. That's not going to be that popular, is it? Could do it for first-time buyers, though. Bring back the cut for first-time buyers. It does make a lot of sense. But then the Labour Party doesn't want to feel that anybody paying over 300 grand for a house isn't paying their bit when they move. They're motivated, they pay it. It's not really killing transactions at the moment, let's face it, because transaction numbers have been okay, and they didn't drop materially. What was materially controlling it a lot more was the cost of the debt, apart from, and as I say, the overall attitude of the people as towards, is it safe to buy now? Are house prices going to go downwards massively, and therefore should we wait and not buy yet? And also, in a way, rents going upwards actually, of course, helps people buy houses because the incentive to buy is much higher. The difficulty is if they're paying rent and they then can't afford, the ability to save a deposit is much lower. But we'll get on to some of that later on as well, yeah? One of the things that I got told after I did a presentation in January 2025 was that Labour were pretty much banking on the housing market to bail them out and get them re-elected when 2029 comes. Little did they know how badly they'd be received in terms of what they've done since then. But it was an interesting theory, I thought. And one way to guarantee that house prices are going well and going upwards is to have a stamp duty holiday. That's what happened in 2021, which actually turned out to be petrol on the fire of what was already a housing market boom due to lack of supply. But that's what it did. The stamp duty holiday did not encourage more people to put more houses on the market, and the government just gave away some money, really. Nothing like some of the money they gave away and some other things, but it did also help people relocate, which did generate some of that activity of your kitchens and your carpets and your overall VAT and all the rest of it, right? So what have we seen over the year? 14.5% increase in vacant dwellings to 303,185. I highlighted that on the 24th of May. Filling the bath with the plug out is what I said at the time. And the cheapest housing supply this country could unlock is not a greenfield site. It's bringing empty homes back to use. And the committee said just the same. Does the political will exist to change anything here? That is the question. The political will is about to change. Then, second part of the deep dive. Bank of England agents report and a regional fracture, right? A great companion to the Housing Communities and Local Government Committee we just discussed. The bank's own agents at the coalface getting the reports from the local businesses, right? So, theme one is the regional fracture in housing. London much weaker than other regions, demand held up better in the devolved nations. We know that. If you've been listening to the supplement over recent weeks and months, you can't have failed to hear that message, right? At the higher end, price reductions now necessary to achieve sales, buyers taking longer, cancellations picking up, new build demand weaker than the secondary market, same regional pattern. Development has all but stalled in London, builders offering fewer incentives because their margins are squeezed by rising build costs. Now, if you've ever got to this far into one of my videos or down the supplement before, this is going to be the third independent source this week that tells us the same thing. Because you've already had Chris Watkin and the real-time property market. We've already had the RICS residential market survey. And now this is the business people out there, their opinions being gathered by the agents of the Bank of England regionally. That's where we are. And so the reason why I'm labouring this three independent sources point is that every instrument has a different blind spot, right? Chris's data is fast. It's price-led, asking price-led primarily. RICS is the surveyor sentiment that's hitting in the estate agencies that they run. And then the agents are anecdotes straight from business, right? So three things built on completely different principles, all swinging the same way. And so any measurement errors or anything you can criticize in their methodology is just navel gazing, right? It's sniffing something you don't want to be sniffing, realistically, that you've produced, let's say, right? Don't worry about the methodology there. Ultimately, they're all pointing the same way, and that, therefore, is as close to proof as we're going to get in this trade. And then there's this nasty little loop of development has all but stalled in London. Build costs rise, the war in part, margins are thin, builders pull incentive, they mothball sites, supply there falls further in the exact spot that needs it the most. Medium-term shortage deepens and the floor under the prices firms right back up. Yeah, so it doesn't make things more affordable after a while. Capital manufactures its own next price spike by refusing to build through this one. I'm not blaming the developers for that, by the way, right? I'm actively speaking to multiple London developers who are just not building right now because they've no confidence in the market they're going to sell into, if they're building to sell, or even revalue into at the moment. And then a fair few who are struggling to shift what they've already built and are therefore not adding any further problems to that pile of problems. Okay, what were the Monetary Policy Committee was actually looking at? Because the contacts out there for the Bank of England agents are seeing weak growth. Obviously, the Middle East has eroded confidence. Employment intentions broadly flat. Recruitment difficulties at or below normal. Cumulative average pay settlement for 2026 about 3.5% in the private companies. In costs, explicitly higher oil prices pushing up input cost inflation, and with broader conflict-driven rises expected to offset the disinflationary pressures elsewhere, though considerable uncertainty remains. So this is the whole dilemma of Thursday coming in 2 lines. 3.5% pay increases, recruitment difficulties at or below normal, so it's a cold labour market, there's plenty of people out there, we know unemployment has risen, right? And the disinflationary side, that is, the argument for sitting still or even cutting the rates. But higher oil offsetting disinflation elsewhere is agents telling the MPC that the war is undoing any of the good work that would do, certainly from the business owner's perspective, easier to recruit, cheaper to deal with rises year in, year out. And this is it. The agents use language like people who are diffusing a bomb. They don't say outweighing. They certainly don't say overwhelming. They say offsetting the two forces, implying they might roughly cancel each other out, which is it makes it impossible to make a clean decision because one thing's pointing this way, one thing's pointing that way. You don't know which force is you're going to take a view as an economist, as a member of the Bank of England Monetary Policy Committee, but you're not going to know because the data won't tell them what to do. So they set policy based on the risk of expectations, and ultimately they look at their own. Do they trend towards being a hawk or do they tend towards being a dove? That's what things boil back down to. And that's why we're going to have a split vote this week, folks, apart from anything else, when the committee does meet. The domestic economy wants lower rates, of course it does, but the imported inflation will not let them have lower rates. That is the problem of the Monetary Policy Committee at the moment, and I do not envy them, right? Now, we know about the north-south divide in house prices. We've banged on about that so much, right? Investors have chased yield up the M1 and they're still cracking on and doing that realistically, possibly going through the M42 and the M6 up towards the northwest more than the northeast, although they're definitely doing a bit of both, right? But this is it, confirmed on the ground, fundamental rebalancing going on, right? Okay, now what about Shelter's efforts and this 119-year figure to clear the social housing waiting list that's just incredibly insane, right? It's hard to read this one coolly, folks. I'm not going to lie to you. It's not about outrage, but I don't want to sound too bloodless either. And I know that economics in general can sound a bit bloodless. So I'm a big believer in us providing good social housing with a good incentive system behind that social housing. Make no mistake about that. And the people who benefit from that are everybody, because society benefits, the Treasury benefits, cohesion benefits, and generations beyond benefit. One of the most damaging things is to be second or third generation unemployed. You've got no role models who are showing you how to work. You've got people who know ultimately they survive on playing the system, right? And or their mindset is so negative that everything you hear as a child growing up is no, and that has an impact on you psychologically. And there are academic surveys that prove that's not conjecture, right? I've sat through lectures about this stuff. I know about it. Social housing needs to be properly funded and properly delivered, and it's an utter disgrace that it isn't. But that's where we are. So the 119-year number, right? This is this 119 years to clear the waiting list. 1.3 million households waiting. 12,198 social rent homes delivered across England last year. 110 households waiting for every one home that was delivered. Annual social rent delivery is down 64% over 15 years. Homeless households in temporary accommodation up 155% in that same period, folks. In 30% of council areas, fewer than 10 social homes have been built in the last 2 years. In 60 areas, not a single one. Right? Shelter's benchmark, England needs 90,000 homes a year, social homes a year, for a decade. Crisis are also on board with that figure. That figure is broadly accepted by the industry, apart from those who deny social housing because they think it just means we're get taxed more and we're spending on people who are feckless and can't afford their own houses or whatever. It's not the case with social housing. So many people who are so critical to our society don't get paid very well, right? And they therefore need affordable rent, social rents, realistically. And they're the cornerstone of our economy when we need them. The same people who didn't have furlough during the pandemic, the frontline people, the blue light people that all of us should be proud of, respect, and do more than just applaud them on a Thursday night during a pandemic at 8 p.m. or whatever joke it was. Anyway, Sarah Elliott at Shelter put that none of us alive today would live to see the end of the housing emergency at this pace. Can't really argue with that unless you're doing some major work on longevity, in which case, if you are, send me a DM. And for once, the campaigning language that Shelter use is, if anything, an understatement of the arithmetic. And I've never said that about Shelter before, folks. I'm not going to lie to you. And then the 1967 comparison. So in 1967, social housing was 46% of all the new build homes in this country. Can you believe that? 46%. Almost all provided by councils, 46%. Now, there's a million differences between now and 1967, right? But we've gone from nearly half of all new homes being social to delivering 12,000 in a nation of 68 million when we delivered. So 12,000 of about 208,000, I think it was. That's 6%, 7%, down from 46%, and 1.3 million households in the queue. Market failure? Well, the markets did not decide this. It's a choice. It's a policy choice that's been made and remade over 50 years. And the 119-year figure is just the bill for that landing, as is the temporary accommodation bill, as is what cripples the local authority budgets around housing as a rule, right? Those social homes served us well. Right to Buy facilitated real social mobility, but it was done as a 1 or 2 generation hit and the ladder was pulled up. There's so much work I would love to do in this area. It would just take someone with real appetite to sort it out. And that means not just the money being put in. Rachel Reeves has done something. 3.9 billion a year, right, for 10 years. It's a start, yeah, but it's social and affordable. And affordable is not affordable, just like temporary is not temporary, folks. This is all wolves in sheep's clothing, all these terms, just like so much of it. Right, I try and keep this grounded as to what it means as an investor, right? But you can see how animated I get about this stuff because this is a serious macro problem. What do we do about that as an investor? Well, we can deal with housing providers that help people with supported housing, with social homes. Ultimately, the councils don't build them anymore, and then they occasionally buy back some of their stock. They are doing things like that, right? But ultimately, they need to lease it off the private sector. So there's most definitely an investment opportunity here with a good social cause and a good social purpose. And what are the problems that we face as investors? We have to pay higher insurance premium. We have to pay higher mortgage rates. Lots of lenders aren't on board with it. The government needs to be encouraging the lenders to do this sort of stuff rather than just the lenders thinking, there's another. I mean, every commercial banker I've ever spoken to on this stuff says, these are brilliant deals. Why aren't people funding them? But instead, they charge you an extra 0.5%, 1% interest. So you're just fattening out the margin for the more mainstream stuff that they do. But ultimately, I'm not blaming the lenders either. They have to deal with volume in order to keep costs down of things. This is not volume stuff. This is not stuff they understand particularly well. I know one large bank currently moved its legal team because they believe that the legal team that they were using was giving them bad advice. And I looked at the advice they had given them, certainly looked at the criteria that came on the back of that advice, and it was a terrible piece of advice. It's a shame they don't come and reach out to people to try and find some more credible expertise in this area. But there we go. So, as I say, it's uncomfortable to say the least, but the mechanism stated as plainly as I can, right? The social home that does not get built does not make the need vanish. It transfers that need onto the private rental sector, which is why PRS rents are not really a rental market story at all. They're the pressure gauge, reading off a 50-year failure to build social homes. And that's why every government scheme to help tenants that reduces PRS supply makes the underlying problem worse, not better. And the hard-nosed strategic read that I flagged back in the spring, the more the state fails to build, the more it ends up leasing private stock to housing people, as I've said. And that's the investment side of things, folks. That's what we're talking about. So Often at index-linked rents with voids and management covered, I've been steadily positioning more of my own asset base this way. Right? I'm not going to apologise for that. I think there's more social purpose to it. I get more fulfillment from doing it, and commercially it works better because you have less slippage. More is placed responsibility-wise in terms of the housing provider and or potentially any RPs that are involved. And this is where the state's failure and the landlord's need for security actually meet. No one should really be happy about that, but I'm being honest, right, as I always am, and that's where we are. Okay. What about the 29 billion anchor? This also is not talked about particularly regularly, and I didn't know this number off the top of my head before I did the work for this week's edition, folks. So 29 billion of historic housing debt was transferred to councils in 2012, the HRA self-financing settlement, which Shelter argues cripples local authorities' ability to borrow and build. Don't disagree with that. You wouldn't fancy 29 billion landing on your collective balance sheets, would you? It's a lot of money to local authorities, right? Shelter now wants it to be written off. That's the bit that I would hardly disagree with, but it could certainly be repatriated into the national debt over a course of a number of years, one way or another. So set that against the 39 billion new social and affordable homes programme. 60% social rent, 300,000 homes over a decade. Plus rent convergence, and rent convergence I won't go into in huge level of detail, but let's just say social rents were frozen for so long that things became completely unviable to hold, and you've got housing associations who cover only 87% of their debt payments with the rent that they bring in, and that's before they consider management and maintenance. So imagine the state of their finances. They're in big trouble. They have to sell assets off. They can only build if they get paid more grant money than it costs to actually build something. What an absolute mess that whole thing is. And George Osborne primarily to thank for how much he ruined the social housing sector, probably deeply. Good old Gideon, Bullingdon Club member, Oxford University, and I've nothing against Oxford University, I did go there, bear in mind. He just crippled things with the way that he did certain things in the austerity programme. Not saying that cutting government spending wasn't part of the way forward. Although again, once the interest rate dropped to near zero, why you wouldn't spend your time trying to find ways to invest in it rather than under-investing in the economy that is now falling apart thanks to potholes, thanks to all sorts of bridges, concrete, this, that, the other, all sorts of things that if you fix them, it would put money out there into the population and grow the economy. George, you moron, the man who happily, laughingly, I listened to him once on a podcast saying how he learned economics on the job. Well, you didn't, George, because you still know nothing about it, right? You did a terrible job. And realistically, behind Liz Truss, the absolute biggest joke of anyone at any senior level of the Conservative Party. And I'm going to pick on them because they were the ones who were in charge for most of the last 20 years, right? So that's where we are. Not that Gordon Brown wasn't an idiot as well. Let's bear in mind. Just to keep it even. So this 29 billion that's sitting there on the council balance sheets, they're servicing this debt, so they've got to find the money to pay this debt. If the Shelter's argument, if they weren't servicing that debt, they could spend it on social homes. There's an element of truth to that argument, of course, right? But this is what people don't really see. And this is the whole reform. We're going to reform the system, right? We're not going to put your taxes up like they've been going up. If you don't know, council tax, generally speaking, can go up 4.99% in statute law. And that is without having to go to the Secretary of State for dispensation. There have been councils, Birmingham being one of them, that has had to go up higher than that over recent years. Some of this was because they froze council tax for so long, and then it caused a much bigger problem. Now, certainly some local authorities, the highest figure I've heard is 84%. 84% of expenditure is on statutory services. They have to provide them by law, as in adult social care, children's care. These are big ones. Housing in general, costing local authorities many, many billions every year, right? Reform can't stop that without breaking the law, yeah? And maybe their plan is to break the law, the Donald Trump plan. Maybe that is their plan when Nigel is in number 10, if he gets there. But I'm not so sure myself, right, in terms of whether they will go down that route and whether it would work in the United Kingdom. I think our unwritten constitution, but our checks and balances are better than what happens in the US. I think a system where you can be get $500 million in crypto, or be Nancy Pelosi and be the greatest stock market investor of all time, on a $400,000 a year salary. All of these things are unlikely and wrong, aren't they? And be worth $200 million herself. That system is broken. Ours is bad. Theirs is worse. Let's face it. Just kleptocracy at the end of the day. But anyway, this 29 billion, right? It's costing them money they can't spend because they've got to service this debt. That's the argument, right? If we get these 18,000 social rent homes a year that we should get from this funding, and we won't hit the target. There's no chance of us exceeding the target. Only individuals like Darren Rodwell, who I'm happy to say actually, I bought Darren's book this week. I'd highly recommend this if you're interested in reading about social housing and genuine solutions, right? Genuine solutions for trying to solve part of this problem. Darren was the leader of Barking and Dagenham Council. He was a Labour councillor. Do not hold that against him. His ideas are brilliant. Thanks, Darren, for signing that copy, by the way. Don't worry, folks, I paid for it. This is not a paid endorsement by Darren. This is from the heart. Darren's community rent model, apart from anything else, is well worth reading about. And this is where you actually see the sensible people anywhere near the centre converge on this idea and how to try and at least address the social housing situation. Darren did some amazing work at Barking and Dagenham in terms of building almost as many social homes as the whole of the rest of London did, right? I mean, incredible. And it's not like Barking and Dagenham is a rich council, right? So just bear that in mind. But he wanted to do something about it. So the current programme is going to do about 20% of the rate that Shelter and everybody else really agrees of the 90,000 social rent homes that I think we need, right, per year. And we won't do that 20%. It'll be in the teens if we're lucky, realistically. Who's the 29 billion owed to? Not a big fan of wiping debt off. Not a very good idea. If you ever want or need to borrow any money again, could you bring it back into general debt taxation into the government coffers? What's costing a few billion quid to service that debt? Not even a few billion, realistically. It could be brought back in. Typical problem with things like this, and especially when people in Shelter who are not business people get involved with things like this, there's no context. How much debt is there in the whole local authority? What percentage of all local authority debt is that? I haven't done that work because it's going beyond the scope of this. I've already gone on way too long this week anyway, but that's where we are, right? So the state's your customer. They have a huge amount of power. They can enable you to they can forward fund projects. They can get funding cheaper than anybody will be able to get funding. This is a win-win situation, right? They can fund through government gilts, apart from anything else. One of the arguments I've heard from a PLC director, who I won't name, is that you should fund, although he does say these things publicly, is that you can fund this stuff through index-linked gilts, as long as you're going to allow the rents to progress alongside inflation plus 1%. Fund with index-linked gilts makes lots of sense, and particularly cheap. Gets your cost of capital down to a couple of percent, right? A couple of percent above inflation, that is, because the investors who are putting money into it know that they're going to get inflation hedged assets over time. Way better than build to rent, folks. I don't mind telling you. And the private sector is working that out for itself at the moment, because build to rent assets are not delivering particularly good returns at all, which frankly anybody should have seen coming if they know anything about property in the UK. But there we go. Who am I to say the 10 billion plus allocated so far has been allocated poorly? But that's what I would say, right? And very clearly. Then we've talked back about Resolution Foundation, talking about small landlords exiting and nobody replacing them. I've talked about that extensively over the last few years. Build to rent at barely 1% of the PRS starts, down 29%. The question I closed on a few weeks ago, who houses the 12.9 million in 2030 that are no longer housed? It's not the waiting list, the 1.34 million, right? Not the new build machine, 30% below its target, 94% below its target in London, but 30% below its national target. Not built to rent and not housing 12.9 million people, right? 1% of the market and falling. It's the existing stock, right? Unglamorous, 2 to 3 bed terraces and semis owned by whoever has kept calm and carried on, folks. Shelter's 119 years is one more brick in exactly that wall. Okay, fourth and last part of the deep dive this week, folks. Thanks for sticking with it if you have all this way through. This is a really novel one, and I read this and I thought it's so nearly really good. And then, of course, like the arrogant person that I am, I believe I've got a much better solution once I've read the paper. But let's see what you think about this, because I think my work is reasonably good here. So Citizens Advance, this is a state alternative to the Bank of Mum and Dad. Yeah, okay. I'm starting getting a bit nervous when the state's lending money, maybe, but Fannie Mae and Freddie Mac work okay in the US if we gloss over 2008. But what does SMF propose here in this paper? Give younger people the option to have their first year of their state pension early in a lump sum, 12.5k at current rate, in exchange for postponing when their state pension later begins. So, not a giveaway. Rests on the contributory principle, eligibility limited to those with at least 10 years of national insurance credits. Motivation, the great wealth transfer, an estimated 5.5 trillion passing down from baby boomers over 2 decades, but only around a third of adults expecting to inherit anything. All adults should never expect to inherit anything at all anyway, to work towards them buying a house, because the average age of an inheritance in the UK is 62 years old, right? So don't get me wrong, if you're still in rental and at 62 you can buy, that's going to be good news for you, but ultimately it's going to have held you back a significant amount in terms of, apart from anything else, the amount of rental stock that isn't available, your geographical mobility, therefore your social mobility, are going to have been held back dramatically. But there we are. Okay, and then polling, most 25 to 40-year-olds were in favour, 54% positive, 6% negative, 50 to 70% say they'd take it depending on terms. Debt repayment, though, is the most popular intended use. Model cost 1.3 billion year one, recouped over time through pension savings. Idea originated with Andrew Lewin, the MP for Welwyn Hatfield. Okay, so it's inventive, I'll give them that. And I am a professional financial engineer dealing with property deals, right? The bit of the job I enjoy more than any other. So I'm always going to have time for this sort of solution, although I think we can do better. And you can see why it polls really well, can't you? Of course, you're going to say yes to money now in exchange for a later retirement they're not thinking about at the moment. And lots of people will take it because a lot of people believe they're not going to get a state pension when they reach that age, especially if they're 25, right? And they're thinking, although I don't know how they've done 10 years of NI contributions, but maybe they started work when they were 15. It's not illegal after all. But of course they'll take it if they think, well, I'm never going to get it in the first place. And most people fail the marshmallow test, folks. Delayed gratification is not their thing. But if you're taking a whole year's worth of today's money today instead of waiting for it to be maybe increased by the triple lock for 30 or 40 years, we all know the triple lock's got to go. It's just who's going to have the courage to do it and what confluence of circumstances is going to happen such that someone can get rid of the triple lock. Or use my own personal solution, which is just push the pension age out in a steady, fair, measured fashion so that people know where they are and put more effort into employing people in the twilight of their careers, especially if they've had manual work jobs. Right, but let's not forget how many manual work jobs have disappeared now anyway, and how much of the economy, 80+%, is in the service industry. So also think about it that way, folks, because unless your mind's atrophied, why shouldn't you be working till you're 70 before you start suckling on the teat of the state? Because ultimately the pension bill is more than half the welfare bill that everyone keeps banging on about, and it must be addressed. Try not to hate me too much for saying all of that, folks, if you don't mind. I'm just the resident economist, of course, right? But I think they've missed the trick here, and maybe this is because I'm someone who uses leverage so aggressively and has used leverage so aggressively in building a significant property portfolio, right? So you're handing a cohort of would-be first-time buyers a lump sum for deposits. What happens is help to buy Mark II, prices go up. You've got your 119-year social housing backlog. You've got new builds stalled in London. You've got the whole supply paradox that I've just talked about. It's not going to make houses more affordable. It bids up the price of the homes that are already there, and the subsidy goes straight to the seller or those of us who hold on and rely on capital growth. So perhaps that's another reason why I should be lobbying for it rather than against it, but I'm just talking about what happened in the real world, right? So this has got to go back to the 0.8% point in terms of pricing that will change if we deliver all these new units that we were supposed to be delivering. 0.8% down. How much more do you think they go up if you could get hold of an extra 12.5k, even if that was solely just for putting it into houses? Yeah, even if you could only access it as a house deposit, which would be viewed as extremely unequal and probably unfair, especially in the world we live in today, because those without enough income couldn't use the 12,548 in order to buy a house. They're stuck in their rentals or whatever, right? Okay, so be a big boost for the economy and probably for the bookmakers' shares in reality, I'm afraid to say, but that's the real world we live in. But it's functionally Help to Buy with a pension bolted on instead of a loan, isn't it? And we ran Help to Buy. We know what happened. We had the receipts. We saw the 100 million plus quid go to the 3 people at Persimmon. for gaming the system so very well. And the settle finding is a meaningful chunk capitalised into higher prices handed to the seller. That's where we are. Professor Cheshire, quoted by the committee, says it perfectly. No policy that inflates demand can do more than push prices up, because supply is inelastic, and that's where it is, folks, right? But you can't just give up on everything, right? You've got to do something within the confines of all of this. So with the SMF's own respondents flagged, if you're going to push out the private rental sector landlords, you definitely want to be able to push them out to people buying those houses, don't you? There is going to be a positive in there. Like I said, it's going to drive the economy, just like a cut in the stamp duty would drive the economy. That's got to be seen as a positive thing to do, right? So ultimately, a 30-year-old is going to take that known 12.5k against the unknowable government revisable cost decades out in a system that's already shown every willingness to push the pension age further away, which it needs to do, as I've already said, apart from taking away the triple lock or means testing the pension or something altogether more unfair that I really, really don't like the sound of. So mortgage their old age. But here is my counter proposal, folks. This is the best bit, I think. Poke the bear and you'll get more. So preserve the pension, yeah, but allow people to borrow against it. Does it need to be the public pension, or can it be the private pension that the employer ultimately is contracted into, contributing into? And this is going to be even more of an incentive for people to contribute into their workplace pensions, which the government has tried to introduce in order to wean them off the teat of the state and the triple lock and the blah, 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 right? So you can already do that with a SAS pension, right? With a small self-administered scheme, you can borrow against the pension. I've got one. I do that. I've used it as leverage. I've used it intelligently. It's helped me to grow the pension massively. And it's also helped me to find stability. Instead of renting a property in a business, we own it instead. This is, you know, a great way of doing it. But hold on a second. Are you then suggesting that you have 100% leverage, Mr. Lawrence? Do you not remember the great financial crisis? Well, I do. And I'm not saying they don't need to have any skin in the game, but we could have a favourable loan here against the pension at a gilt rate charged, trapping the pension fund as collateral. Like I said, I would do this with private workplace pensions, not with state pensions, but you could consider it with state pensions, right? It'd be a hell of a fillip to the economy. I don't mind telling you, hell of a shot in the arm, right? So it's a great way to awaken the sleeping giant of UK pensions, yeah? And it fixes some stuff in the SMF version. You're not spending it, you're not losing it, you're securing against it. You might have a loan that you pay back the pension over the course of 25 years, right? You could pay it back by contributing it into the pension, so it's pre-tax instead of post-tax. There's loads of little clever ways you could make this work and make the maths a lot more sensible. So the pension pot is still invested because you've borrowed against the pension. You haven't borrowed out of the pension, just to be clear, right? So this is new money, debt that's being created. This is, in my opinion, the much cleverer financial engineering bit. Although having said that, their solution is also new money because you're borrowing from 40 years in the future from money that doesn't exist yet, because we fund pensions at the time rather than investing. The biggest single mistake that was ever made about pensions, by the way, was funding them now in real time now rather than putting money in like you did with child trust funds, like those sorts of things that happened. They were brilliant, right? They were absolutely brilliant. Someone's just commented saying, we come into this life with nothing, work to the bone for money, fighting to get this and that, and then you die, then you leave with nothing. What a life. Look, David, I don't know if you've ever read Die With Zero by Bill Perkins. It's a great book. If you haven't read it, I recommend that you do. My grandfather passed away and he had £2 in the bank. He left my grandmother with 60% of his private pension that was very, very good, because he always insisted on good pension when he got promoted at work, and he had a near executive pension even though he was never an executive. He had a magnificent life, to be honest with you, and died with nothing and therefore paid no inheritance tax, and fair play to him. Really, really good. So enjoy it while you're here would be my attitude, and try and love what you do is the other best way to try and combat that. But anyway, I digress, as I often do, right? So is it 100% leverage? Is it better than their solution? I think it really, really is. And it doesn't shaft people in the future. It doesn't cost them that extra year in their pension. And it extends the bank of mum and dad in a massive way, because mum and dad's pension might now be on the table for them to take money out of it for your house deposit if you restrict it to houses. And I think you probably should, because if you just let it out there in the economy, My goodness me. It'd be some economic boom, though. I'll tell you. You have to do slowly catch your monkey. Maybe start with house deposits, see how it goes, then put it towards other things, like, for example, consolidating debt. But then you're borrowing, people are borrowing in the future. People are already shown they've got debt in the present. But you'd rather they have the debt from the future at the lower rate than the debt in the present, right? David said he doesn't have a family. He can't save. He's got low income. Do you know what I'd also do, David? I would have a look at Damien Talks Money podcast. They had someone on there a few weeks ago, incredibly inspirational, low income, has managed to save, has got into investing, is really enjoying it. And it's such a superb episode of a real life thing. I appreciate that sitting here as someone who's got a massive property portfolio is probably not the sort of person you want to get advice from. But have a look at that Damien Talks Money episode. It's well worth watching. And it's a great podcast if you're not already aware of it, because it's real talking stuff. So have a pop at it. But anyway, back to Bank of Mum and Dad being massively extended. If they could access their pensions to put into their children's house deposits, but not actually have to cash their pensions in to do so, it really does create a potential opportunity. So David says thanks, and I say, David, you're welcome. All the best and good luck. But yeah, look, close the loop here. We've got Help to Buy. We talked about. We've got the Bastiat quote from a couple of weeks ago. This is a leg up. This is what we see, right? We see a leg up for the young who do need help on this housing ladder. The unseen is the price rise that swallows a straight handout, right? Pension secured loan version is the rare design. It mobilises capital without feeding it straight into the seller's pocket. The same lesson we learn roughly once a decade, and then we forget it just as fast, right? So I know it's been a really heavy week, folks, and if anybody has listened all the way through, make sure you leave me a comment. You deserve a medal today, because I'm coming up to 3 hours on this one. But let's try and draw it all together. It's been a heavier week than most, a softening market, flip rates outlook now really truly official, and a stack of reports all pointing at the same affordability wall. So I'll end where I always do, on the fundamentals, because they have not changed, right? The Select Committee framed the paradox. You can't fix a supply problem with a demand-side checkbook. The bank's agents confirmed the regional fracture from the coalface. Shelter quantified the scale of the state's failure, 119 years. 46% of new homes once social at their peak, now 12,000 a year, now about 6%, right? And SMF gave us this perfect cautionary tale of doing exactly the wrong thing, which is why I offered a better version. 4 reports, 1 wall, demand locked in, supply locked out, the gap widening in slow motion, and under all of it, Henry George's land question still unanswered after 146 years. And the fundamentals, right? There is a shortage of 2 to 3 bed terraces and semis. There was when I started this back in 2011, and there still is today, right? Every report I read, everything I point to, not that I search it out to verify my own position, it just confirms it again and again and again. And just this morning, I saw someone say, well, people need to build more 2 and 3 bedroom houses, but they build 4+ bed executive detached because they're the only houses with any margin in these days, because there's so much regulation apart from anything else underneath that you can't build 2 and 3 bedroom houses as a small developer. You need them on estates of hundreds in order to make it workable, right? And even then, in this climate where you're not selling them quickly enough, it's not workable, right? Investing in property is not a guaranteed win. Folks, the rates conversion to conversations turning to hikes rather than cuts. You need discipline at the moment around leverage and loan to value. It matters more this month than it did last month, and it's going to continue doing that, right? But investing in undervalued areas that are strong on the spreadsheet, strong on yield, bought below their replacement cost, in a market that is repricing slowly in real terms rather than crashing in nominal terms, that remains as close to a guarantee as any game in investment will offer. And it's how you stay ahead of an inflation rate the public has very much noticed. The houses still are not being built and the people still need somewhere to live. The rest of it is all noise. Now, I just want to tell you about our next property business workshop, myself and Rod Turner, Wednesday the 1st of July in central London. Due diligence, and I mean real due diligence, performed by you on lenders, on prospective joint venture partners, and on you by lenders and prospective investors in you. Right? What should we be doing about partners, companies, counterparties, including lenders and borrowers, and most importantly, on property deals? The legendary live due diligence exercise with no stone unturned is always popular and has even had predictive value on which smoke sellers to avoid. Right? This time, for the first time, I will be assisted by my wonderful assistant, Claude, who many of you will be aware of, but it does incredible things in real time for due diligence. So it really is some excellent stuff. There'll be some AI thrown in there as well as a little bit of a bonus. We then have our no holds barred Q&A. It's not recorded, so we can say whatever we want. And then we have a VIP dinner. Last time out in Manchester, it set a new standard. I'm sure we're going to beat that standard again in London this time. It's the best way to get access to Rod and myself over dinner to talk through your own circumstances. Tickets are selling now. The link is in the description. www.tinyurl.com/PBWELEVEN. Also, just Google Property Business Workshop 11 and you will find it. Hope to see you there, right? But whatever you do, even if you don't come to the workshop, even if you never listen to one of these again, because I've gone on for too long this week, always keep calm, listen to the supplement and carry on. Let's go, folks.